online'owym, więc tym bardziej cieszymy się, że wybraliśmy także tą drugą formę dotarcia do wszystkich zainteresowanych, ponieważ niebawem będziemy zaczynać, także zapraszam. Można wziąć ze sobą kawę, napój. Dzień dobry, nazywam się Nina Wincens-Krajewska, jestem rzeczniczką prasową Warszawskiej Giełdy. Bardzo miło mi Państwa powitać, przynajmniej tylu, ilu udało nam się tutaj zebrać ludzi. I tak doceniamy, że znaleźli Państwo czas i też w ramach takiej dość trudnej podróży do naszego biura jednak dotarli. Witamy także bardzo serdecznie tą większość jednak uczestników, którzy online'owo teraz nas oglądają. A okazja jest nie byle jaka, ponieważ dzisiaj jest pierwsza edycja Forum Wymiany Wiedzy. Miło mi bardzo powitać na sali notowań GPW przedstawicieli instytucji związanych z polskim rynkiem kapitałowym. Witam przedstawicieli instytucji międzynarodowych, w tym Światowej Federacji Giełd, Federacji Europejskich Giełd Papierów Wartościowych oraz Międzynarodowego Centrum Zrównoważonego Finansowania. Brawa! Pragnę zwłaszcza serdecznie powitać naszych dzisiejszych prelegentów. Richard Metcalf, dyrektor do spraw regulacyjnych Światowej Federacji Giełd. Brawa. Mark Kukaustia, profesor na Wydziale Finansów Uniwersytetu Aalto. Brawa. Oraz pani Linda Zeilina-Cross, dyrektor generalna Międzynarodowego Centrum Zrównoważonego Finansowania. Brawa. Serdecznie witam również przedstawicieli klientów giełdy, a także obecnych na sali dziennikarzy. Z uwagi na międzynarodowy charakter dzisiejszego wydarzenia oraz naszych dzisiejszych prelegentów, wydarzenie będzie prowadzone w języku angielskim. Okay, so now we can switch to the English. I once again warm welcome to all of you enthusiasts to know more about capital markets. And now I invite Monika Gorgoń, member of the management board of the Warsaw Stock Exchange, to join me on stage and say a couple words about our new initiative and the idea of the Knowledge Forum.
Dzień dobry, good morning. Dear guests, it's my great pleasure to welcome you all to the inauguration of the first edition of the Knowledge Forum. This new idea, which is one of the key initiatives of the new strategy of the Warsaw Stock Exchange Group, will serve the participants of the Polish capital market by supporting the existing knowledge transfer infrastructure. We know how important it's to have the access to up-to-date information in the ever-changing financial landscape. In times when information not only supports the business, but it's actually the basis for success, sharing knowledge and experience becomes one of the most important resources. I believe that expanding knowledge is also one of the tools to deal with the complexity of the current market challenges. That's why, together with our partners, the World Federation of Exchanges and International Center for Sustainable Finance, we want to create the unique platform for knowledge exchange. This forum is designed as a channel for exchange of ideas, experience, and know-how, the place where diverse perspectives meet. I hope that this forum will prove that cooperation and knowledge sharing lead to the innovative solution and better results. For now, we start today in conference format and welcome 3 excellent speakers who have agreed to be with us personally and share with us their knowledge, experience on ETFs, ESG, personal value, and stock market participation. I encourage you all to actively participate, get involved in this initiative, and take advantage of it as a networking opportunity. Thank you.
Thank you very much, Monika. And now our first speaker, Mr. Richard Metcalf from the World Federation of Exchanges, will make a presentation about exchange-traded fund. Please join me on stage.
Hello, my name is Richard Metcalf. I'm Head of Regulatory Affairs for the World Federation of Exchanges. Very pleased to be here in Warsaw, supporting our member. Thank you very much indeed. See if I can make that stand there. Could be risky, could be okay. I have been with the World Federation of Exchanges for about 5 years. We have members all around the world. We started off as a small regional organization for stock exchanges. And as the development of stock markets and derivatives markets and central clearing has proceeded over the years, we've added quite a lot to that membership, and our membership is growing, which is good, because what we find is that there are a lot of policy issues and a lot of business practice issues that need discussing in a collective forum. So we're very pleased to have a great diversity of members. We have big stock exchange groups that own all sorts of other businesses as members. We have very small exchanges in some countries where they are just the financial market. There's very little else. We have exchanges that are very, very, very advanced on ESG, for example. We have an increasing number, who are focused on exchange-traded funds, which is mainly what I would like to talk to you about today. But what we find is that the exchange of knowledge between our members and the exchange of views is vitally important for the overall growth of the exchange business and central clearing as well. We have a lot of clearing members amongst our membership. And that if you're running everything from a main board through to something aimed more at startups, or maybe are working with entities in the private equity world as well, which a lot of our members do, there's a lot of things to pull together in what is a challenging environment. We all know that globally, it's quite hard to maintain growth in listings. But again, exchange-traded funds add an interesting dimension to that. When we have, when I joined the World Federation of Exchanges nearly 6 years ago, one of the first things I did was go to the Arabian Gulf, where we were going through a process of accepting a new member. And I asked them what their top priorities were. 3 things. One of which was derivatives. Okay, that makes sense. Related to that, a clearinghouse. And the third thing was, what can you tell us about exchange-traded funds? So even though the vast majority of the ETF business, maybe not vast majority, but the majority of ETF business, and I think growth, is still in the US, it's an interesting space for very many reasons, which I hope I can go into today and explain. And I think that we will continue to see very strong growth in this area for various reasons, which I hope I will make nice and clear for you today. I'm very happy to take questions as we go. I don't know if people who are watching on the stream will be able to send in questions, but I'm very happy to take questions from you in the room at any stage. If there's something that doesn't make sense, or you think is wrong, or you'd like more information on, please wave and we can have a nice informal discussion about it. But before I get into that, thank you again very much for the invitation to participate. We really appreciate the chance to work closely with our members to have a technical discussion that looks at the ways in which financial markets, transparent public financial markets, can interact with society more broadly, with retail investors as well as institutional investors. So, thank you. Very great pleasure to be here. Now, I've called this exchange-traded funds a window on the world because I think that with the concept of the exchange-traded fund and with the growth that you are seeing in this business, that reflects a fundamental point about financial instruments, which is that some are a very good way of gaining the sort of exposure to risk and reward that a broad range of people want in a package that is very flexible and which brings advantage over the existing models, what some people call a better mousetrap in the jargon. So I'm going to split this discussion into 4 sections, pretty logical. I want to do some scene setting. I want to paint you a picture of how exchange-traded funds have come about and what's going on in that world. I believe that I'd understood from that the audience would be generally familiar with the concept of exchange-traded funds. I hope not to be too simple, but I hope not to be too far ahead. So again, if there's anything you want to check, please, please, please do just let me know. Thank you. So, in terms of setting the scene, I suppose that the most obvious, but also in some ways the most profound thing you can say about ETFs is that it's like a mutual fund, a collective investment scheme, UCITS if you like, that trades like a share. That's obvious in some ways, but when you think about that, it suddenly makes you think about a whole load of other things. Mutual funds price at the end of the day, which has profound consequences for how much action there is on a stock exchange and when. It's a very obvious trend in stock exchanges that most of the, or a very large amount of the action of the price formation happens at the end of the day. With an ETF, you can trade intraday. You can trade in a diversified manner. You can trade in a way that may be very tailored. Most exchange-traded funds come in a way that has broad appeal, typically relating to an index, a stock index. It will be a long-only investment in a major stock index that is familiar to you. But you can trade that all day, every day. And the alternatives to that are very few and far between. You could trade futures, but you have to set up a futures account and then watch the margining processes. It's a very powerful tool, very useful. A lot of investors use both ETFs and futures. But with the ETF, it's maybe a little bit simpler. You track what is happening to the WIG, the FTSE, the S&P, whichever index you want. And on top of that, you might be able to trade an index that is not in your local jurisdiction. You might be able to trade the Japanese stock index or some sector within those, or a cross-border sector, automotive companies all around the world, for example. So the minute you talk about an ETF, you're talking about something that sounds quite simple, a packaging up of shares, but in practice has some quite profound, significant dimensions to it. The start of this market was basically in the passive area. The idea was, yes, it's tradable, but it's also something that would function as a passive investment. You have exposure to your chosen stock index or other underlying asset, and you can just leave it there and benefit from not having to trade the market, not having to check whether your fund manager is trading the market too much or too little, not having to worry about market timing. And of course, that reflects some profound changes also in the way that investors have tended to look at investment. As I suggested a minute ago, from an exchange point of view, the ETF is very valuable because in a world where you don't necessarily always have a constant flow of new listings, the ETF brings value by creating something that will appeal to investors and is tradable and has price discovery. And I will come back to this, but the role of ETFs in price discovery, I think, is becoming increasingly important relative to the underlying. I'm not saying it's all happening in the exchange-traded funds, but it's certainly a very important dimension. The final point is that the way that this is packaged means that it is accessible to, and in practice is proving popular with, retail investors. I don't know how much of that is the thematic side of things, and I don't want to get too far ahead of Linda, but obviously there are things like ESG exposures within ETFs that are quite interesting. But the truth is that there are jurisdictions where the ETF is very popular in absolute terms amongst retail investors, but also as a proportion of what retail investors are doing, and I'll show you a slide later, but as a part of what retail are doing, the ETF is becoming increasingly important, and this is very, very, very clear in the US, which, as I say, is, at the moment at least, the biggest market. But I've heard anecdotally that it's also true in Germany, for example. I had that from a large fund manager whose name will be very, very familiar to you, one of the entities that is biggest in the ETF space, and they've been saying this for a few years. So there's some background. Any questions so far? I guess not. Okay. So I want to talk to you very briefly about market growth. It's very easy to find statistics on how the exchange-traded fund market is growing. But just to set this in context, for me, one of the biggest, most striking things is that So in previous jobs, I used to track the growth of hedge funds. Nobody was talking about ETFs at that point, maybe 20 years ago. Not really. People knew about them, they were beginning to grow. But everybody was saying, oh, hedge funds, alternative assets, pension schemes, and other institutional asset owners and managers were increasingly allocating a portion of their funds to hedge funds. And that market was growing steadily, you know, from $500 billion to $1 trillion to a few trillion. But ETFs have, in the last, I suppose, 10 years or so, suddenly overtaken that whole trend. And I think it goes back to the sorts of things I was saying a minute ago. Whatever the cause, it's very clear that this is the thing, and I suppose part of the reason is the accessibility. So we're now talking about something like $10 trillion equivalent of assets under management. As I said, all of these figures are easily available on the internet, so you should be able to track down these things relatively easily. That's twice the amount that is currently managed by hedge funds. Now, hedge funds started in 1950-something, and they grew quite slowly initially, but I recall that in the 1980s, at the same time that banks were doing a lot more proprietary trading for their own books, a lot of hedge funds were starting up, a lot of them focused on derivatives, but many spreading out over other assets. And that whole phenomenon seemed to be where all the action was. They were promising superior alpha because they were challenging essentially the established institutional asset management model. ETFs started in 1990. Most people think it's 1993, but for those who are real nerds, geeks, who want the proper trivia, 1990 was the first one in Canada. Most people think it was the ETF linked to the S&P that was launched in 1993, which is the biggest in the world, most famous. But there was a Canadian one created in 1990 in Toronto. The point is, though, that from 0 assets under management in 1990, they grew, but only steadily. So 100 billion in 2000, well, it's a lot of money, but in comparison with tens of trillions of assets under management across the world, not that much. But then in 10 years, it grew tenfold, up to $1 trillion. And we're now talking about 10 times that, and the growth seems to be there. And I'll show you some charts to back that up. I think that a lot of that is to do with the growth in tying to indices, to stock index indicators, and passive investment. You won't need me to tell you that in the world of fund management, it's very common for people to follow an index, even if they don't explicitly advertise it as an index tracking fund. But there are index tracking funds as well. I think that even if you outsource the decisions about what to invest in and when to a fund manager, you always have to keep an eye on that, whereas just following what's happened to the stock index is relatively easy. You can even follow it intraday if you want, and trade out during the day if you want. In the active management world, there's the questions of fees, which necessarily are higher in the active management space, and then you get into questions of market timing and transaction costs, which you can mitigate to some extent in the ETF world. And we won't go too much into that, but it's been striking, for example, in the UK, and to a lesser extent in other parts of Europe, that the regulators are increasingly concerned about questions of value for money in the fund management area. So to some extent, the ETF reacts to that, and that's why we see certain trends in the way that the ETF is positioned relative to traditional active asset management. So I would say that the growth mainly comes in the plain vanilla area, as we call it, long-only index ETFs. But we've started to see more and more use of exchange-traded notes. In other words, bonds that package together a wide range of exposures, perhaps to a whole stock index. We've also seen the phenomenon of exchange-traded commodities, which is a relatively small part of the market. I don't think it's growing particularly. It's an alternative way of capturing exposure to an active management of futures contracts, derivatives. We've seen a lot of geographical expansion. This was predominantly a US phenomenon until I think that serious growth started happening in the early 2000s. So the US is, perhaps not surprisingly, still the biggest market, about 7 trillion of assets under management, the majority of which, as you'll see on the slide, is dedicated to equities, and the majority of that is devoted to US shares. It's going to be the Standard & Poor's index, or the Dow Jones, or maybe some segment of that, but typically it's going to be focused on US underlying stocks. But still, 1.4 trillion of bond-focused ETFs is quite a significant amount of money. And you see a similar proportion in Europe and Asia. Asia, as you will see, is still a very small market for ETFs, but there's a lot of money in Asia, and I would bet that there will be quite a lot of growth there over the next few years. Part of that, I think, is probably going to come from this ability to tailor ETFs into a sort of sector or thematic idea. The WFE in March of this year launched something called its Green Equity Principles, which is a framework within which an exchange can designate shares as green. So you've already got green bonds. Now you can potentially have green equities. It's based on a certain threshold of revenue being generated by the company in a sustainable way. And part of the reason we did that was because we were thinking, well, if you can have green equities, you can also have green equity derivatives, and you can have green equity ETFs. Anyway, if you're interested in that side section, that publication, by the way, is open for consultation. So if you do have an interest in the idea of green equities, please speak to me, look up our website. Please feel free to comment on the framework that we have created for that. Okay, advert over. I think that's it on growth. There's some nice pictures to back up what I'm saying. I couldn't put together a global number. Well, I could, but it probably wouldn't have been as interesting. The value traded is not uniformly going up, but generally it is. I think that in Korea it probably will come back up. But as you see, over the past few years, with some ups and downs, there's been pretty strong growth in this area. So there you have a couple of US exchanges and a couple of Asian ones, just to give you a bit of a mixed picture. This information comes from our own database. The WFE runs a database tracking turnover, listings, all those sorts of things. So if ever you want to compare what's happening in one country with another or look at the global scene, just go and click on our website. and I can put you in touch with my colleagues in research. In terms of market capitalization, again, generally speaking, the trend has been up, certainly over this time frame, which is about 5 years. And I think if you look at the global number, with more and more exchanges working to create ETFs and being quite creative in terms of thinking what would work well for their local investor base, you'll see that that number is going to be growing pretty strongly. That seems to be a dead cert. Just to help you with that global split, I thought a pie chart might be quite memorable. So there you see the roughly 10 trillion. The source for this is iShares, which is a good source also for data. In terms of market trends, sorry, excuse me 1 second. Terribly sorry. In terms of trends in the market, one of the most interesting things that we hear anecdotally and which we see to some extent in the statistics is the growth of bond ETFs. From those figures that I was just quoting in the previous slide, at the moment, the total global bond ETFs market is just under 2 trillion, as opposed to nearly 8 trillion in equities. But it does seem to be growing quite rapidly, and that's what we hear from our friends in the asset management world on the global scene. And in a strange process, recently you've started to see the creation of ETFs that have a fixed maturity. So you've gone from something that's an open-ended product with no maturity date, just sits there, to there now being ETFs that target a particular bond portfolio and replicate the effects of holding a certain portfolio to maturity and no longer. And, you know, the logic of that is, I think, quite easy to see. There are people for whom that makes sense. You want a bond portfolio that runs for a certain length of time. You might renew it, you might not. But the ability to do that is now coming in. So you're seeing the ETF evolve in a way which more directly replicates some of the things you can do in the underlying securities markets. There are, of course, other underlying assets. There's a big debate, as you probably know, in the United States as to the extent to which ETFs should or could reflect and reference crypto assets. At the moment, you can do ETFs that reference crypto futures contracts, but not the Bitcoin itself. There is some speculation that might change, but for the moment, that's not the case. You can also do weird and wonderful things. You can basically create an ETF on pretty much anything you like. There are some exchange-traded notes that have been linked to, for example, volatility indices. You are all familiar, I'm sure, with the VIX index, which was created 30, 40 years ago in the US with the help of one of my colleagues at the WFE. And you can create what are, in essence, structured notes which link to a volatility index. It's proved very popular. It also proved quite volatile itself at one point, but that's another story. And that highlights a point that for many years there's been a very strong structured products market in many parts of the world, in many individual jurisdictions. Again, I would think of Germany and Switzerland particularly. But there's no reason why you cannot combine what you do with an ETF with the effect of derivatives. And so you're seeing that quite a lot as well. One example is something called a buffered ETF. You give up some of the upside potential. You don't get all of the increase in the stock index, but you also get some protection against drops in the price. It's not complete protection either way, but it's a combination of buying and selling options that creates that exposure profile. According to our friends in the asset management world, you're also seeing income products. So, for example, you could combine, sorry, not combing shares, but combining shares. My apologies. You can combine shares, a shareholding, with the sale of call options, a covered call strategy, which is, which is quite common in some stock markets. In the US, it's very common, even at retail level, to hold shares, but also sell call options on them to earn extra income, with the risk that you then have to sell the shares, but you're selling them at a price that you would have sold at anyway. So you're seeing that sort of thing. You're also seeing outcome products, which means that you would have a strategy embedded in the ETF. It would start out investing probably in growth shares. But over time, the balance would shift and more of it would go into bonds. And that's designed to meet the needs of people as they grow older. Classic investment management strategy. You're younger, you buy lots of shares. As you get older, you put more money into bonds. So you're seeing that effect, that sort of strategy being replicated in the world of ETFs. And then, of course, you're seeing derivatives on ETFs as well. As I mentioned earlier, it seems that most people view ETFs as part of a toolkit, so you wouldn't necessarily only invest in them. You might have a portfolio of shares, some ETFs, and maybe use some derivatives as well at the same time. That seems to be the way that people are thinking about it, certainly. I promised you some figures earlier. No, I didn't promise you these figures, but I'm going to show you some figures. If you look at the US market, where you've got this 7 trillion of assets under management, you see this left column, and these figures come from one of our members, NASDAQ. The chief economist at NASDAQ, Phil McIntosh, writes a very interesting blog. I would recommend it, not just for news on ETFs, but how the US stock market functioning is generally. If you look at the left-hand column, that is US-listed exchange-traded funds that reference US shares. So, pretty much not the only game in town, but the main deal. The next column is, and I do apologize for the small print, but the next column is overseas equities. So basically equity, that's where your 5.6 trillion of equity-based investment comes from. And then the next is fixed income, so reasonably important. And then you've got some other stuff going on, including these futures-linked contracts. In terms of what's going on in the market, because of the way that ETFs have really captured the imagination, you're seeing the start of what seems to be quite a strong trend. Lawyers certainly tell us that there's a lot of work in that area for them, of mutual funds, traditional mutual funds, which strike a net asset value at the end of the day, and that's the price that you can trade at that day. A lot of them are thinking or actively pursuing conversion to the ETF format because it's proving so popular. You're also seeing the growth of active ETFs. So you give somebody some money, and they basically follow a mandate, a little bit like active asset management. But they do it within parameters which helps to keep the costs down, or at least generally do that. My understanding is that is especially active in fixed income, surprisingly enough, because often you think of fixed income as buy and hold. One of the big debates is the extent to which the manager then should provide daily disclosure as to what the underlying portfolio is, or whether they should have some ability to shield that information to protect their trading strategy. But it's an interesting phenomenon. There's also a phenomenon of white labeling as more and more people want to create ETFs. Big providers in the market can come and support that with these services that go from seed funding through to compliance and custody, through to distribution and marketing, and I guess, regulatory reporting where necessary. So there's some very interesting things happening at the edges. The main core is still index only, not growth. I was just going to mention very quickly something. I've already touched on the issues around collective investments and passive, leading to a concentration of quite a lot of activity in the closing auction. And exchanges are aware of this and think about how to encourage participation during the rest of the day as much as possible. That gets you into the microstructure. Another story, but it's out there in the background. Alpha has proved elusive, or at least it's very hard to produce outperformance consistently and for everybody to do it consistently. Almost by definition, that's very difficult. So the passive element comes through because of that. And there's been a debate in recent years, not in the last year, but over the past 5 maybe, about the extent to which passive investment is consistent with active stewardship, which is something that some people worry about. And Jack Bogle, who invented, or more or less invented the ETF, said perfectly consistent. Something to think about. But it's certainly, there's no reason why as an ETF holder you cannot express a view which feeds through into the ETF manager as to what communication should go through to the underlying companies. Now, I want to spend a little bit of time. Are there any questions at this point? We're all good. Not too far ahead of you. Not boring you too much. Okay, good. Can I ask for a quick show of hands? I'm not going to start a conversation with you, don't worry. But are you looking at ETFs? Do you have ETFs within your business at all? Is this, yeah, I'm getting a nod there. Yeah. So, okay, good. All right, fine. Interesting. Maybe we can speak afterwards. I want to talk a little bit now about the world of regulatory discussions. I'm the head of regulatory affairs for the World Federation of Exchanges, so naturally this is an area of particular importance to me. But I would say that with the growth of all forms of exchange-traded product, there has been a huge growth in the regulatory interest. I would say a lot of it is trying to understand not the basic concept, because the basic concept is very straightforward, but I would say trying to understand the implications of that, some of the subtleties, some of the ways in which that basic concept is being modified. What happens if your ETF is listed in Warsaw but tracks the performance of, North American stock indexes? What happens when Warsaw closes for the day? What do you do about net asset values, indicative net asset values, that sort of question, and many other questions besides. So there's a lot of things to consider, and a wide range of regulators, from national regulators, for example, the Central Bank of Ireland, where a lot of funds are domiciled, has done a lot of work in this area. But so has the ESRB, the European Systemic Risk Board, the offshoot of the ECB. So has IOSCO at the level of international principles for securities markets. So has the BIS, the Bank for International Settlements. The BIS always worries about systemic risk. It sees systemic risk everywhere. So when they see a new product, they'll say, how much systemic risk? Naturally, the Securities and Exchange Commission in the US is pretty important here, if only because of the size of the US market, but also for other reasons. And I want to talk also briefly about the role of the Federal Reserve Bank, in New York during COVID, which is quite interesting. So the sorts of issues that crop up amongst all these regulators, IOSCO, BIS, SEC, Federal Reserve Bank, and the ECB, well, IOSCO is a good example of the sort of things they're looking at. What are the disclosures like? How accurately, how well does the prospectus describe the product and what it gives you? The classification, in other words, what type of product is it? What are the underlying portfolio constituents? And can those change over time or according to rules? What are the costs? And any offsets to those costs. One of the interesting things in asset management is the ability to lend out securities, so that comes into play in ETFs, maybe not a major issue, but part of the overall picture. What sort of strategies are being deployed in the ETF? All of those things come out in the disclosures. Are there any conflicts? Is there any risk that material non-public information is finding its way into the hands of people that it shouldn't do? I don't think there's a specific problem on that front with ETFs. It's just, this is like a checklist. This is what IOSCO does, right? So it's saying all of these things are legitimate questions in relation to ETFs, just as they are to any other form of asset management, I suppose. There is a further dimension which is quite interesting because there is the possibility of creating synthetic ETFs, which involve the use of a derivative. That has been popular in Europe, although I would say that is not growing at the moment. I think most people want something that is simpler, particularly if they're a retail investor. But if you're trading synthetic ETFs, there is the possibility of the question of whether the counterparty will perform, obviously. These all come from a June 2013 document published by IOSCO called Principles for the Regulation of ETFs, which they recently updated. They updated it on the basis of a quick report they did in 2021 on the back of what the experience with ETFs was during the COVID time. And ETFs were pretty high profile during that time. And they ran a consultation more recently looking at whether or not the principles were still valid. We told them that they were. We added some comments, actually, which I'm going to read to you in a minute. One of the focuses during all of this work was the extent to which there was a discount to the net asset value for fixed income ETFs during COVID. Now, I say discount with the little, quote marks. I'll explain why in a second. That difference in price was anywhere between 6 and 10% at its peak in March 2020. It was highest for high yield bonds. It was somewhere in the middle for investment grade bonds, and it was relatively low for government bonds. But the problem was not with the ETFs. The problem was with the underlying bond markets. They were stale. There seems to be a phenomenon, and this is not my words, I'll quote to you from the IOSCO report, but you can see the words there. The ETF structure has generally remained resilient during historical stress events. No major gaps have been identified and no major regulatory issues were reported by IOSCO members or industry participants. As of the date of this report, IOSCO has identified no structural issues related to ETFs that bear on financial stability. So that was from the report that came out in May of this year. But that comment is consistent with the fact that people view the ETF as a better indicator of price formation than the underlying shares themselves, which is quite an interesting thing. I'll come back to that in a minute because there's some other interesting information. But just to finish off on the IOSCO side of things, the Good Practices document that was published this year in May set out 4 themes. There's 11 recommendations in total, but there's 4 major themes, one of which is about product structuring. Mostly the report is, I would say, descriptive. It's not saying, thou shalt do this, thou shalt not do that. It's saying, this is kind of how it works. They are concerned to make sure that the product structuring has integrity, that it actually follows the index it's meant to. Disclosure remains absolutely key. Does the consumer have a good chance of understanding what this product is about and why it exists? And as part of that, do you know about the fees? Do you know about the structure of anything securities lending? Do you understand the difference between the exchange-traded fund and a traditional mutual fund or UCITS? What are the liquidity provisions? How certain can you be that you will be able to trade in and out of the product because it promises that daily, intraday liquidity? And what about volatility control mechanisms, otherwise known as circuit breakers? Circuit breakers are a very, very important part of the market, just like short selling is a very important part of the market because it allows you to have confidence that the price formation is being done in an orderly way, that you're reflecting all of the interest up or down, but that, I'm so sorry, I'll stop doing that, but that in the event that the market is exceptionally volatile, which threatened to happen during COVID, there is a way to shut it down. There is a related question, which is how do you make sure that the ETFs shut down at an appropriate point, which may be at the same time as the underlying shares or bonds or whatever, but it may not. If the ETF is still pricing accurately, you may not need to do so. But certainly the calibration and coordination of circuit breakers is quite an important issue. Now, coming back to this question of the way that the ETF prices and how that compares with what's happening in the underlying, there was a very interesting report published by the Bank for International Settlements, the Basel-based entity, back in 2020, April of 2020. And I've even included, for those of you who want to scribble it down, or I can give it to you afterwards, the reference to the paper published by Aramonte and Avalos. Again, the words are up there, but I'm going to read them out because they are pretty significant, I would say. ETF prices are more reactive to market developments than the underlying bonds, especially at times of market stress. As such, ETF prices are probably more suitable inputs to monitoring efforts and to risk management models, including those underpinning regulatory capital calculations. They're more suitable than relatively stale bond benchmarks. And that is pretty much, that's a pretty significant endorsement, I would say, of the ETF mechanism. The BI, this is not an official Bank for International Settlements view. They publish research papers. It's, not officially BIS, but they still publish them. They're written by BIS staffers. So I think they carry a certain amount of weight. There was a paper published in 2021 by one of these researchers, somebody called Karamfil Todorov, which suggested that the sponsors of ETFs might be exercising a cheapest to deliver option on bond ETFs in particular. So when redemption requests came in, they say, sometimes an ETF has the option to provide any from a very wide range of underlying assets. There was some suggestion that some of them might have had an incentive to produce the bonds that had sold off most. The evidence showed that that was not actually true, and there's a number of incentives why you wouldn't do that, not least the fact that nobody would ever trust your product again, probably. Anyway, the full reports are out there. You can go and make up your own mind, but the conclusions are pretty, pretty clear and pretty straightforward and pretty supportive of the ETF itself. Now, I did promise you something talking about the role of the federal, the New York Fed, and what happened in 2020. This was not so much a report as a series of actions. You may recall this. When COVID struck the markets, or struck people, but with knock-on effects on the market, there were a lot of concerns. We were working very hard to try and counter some suggestions from some very senior people in the US public policy world that markets should actually close. Saying, really? You need the markets, otherwise you're just going to create uncertainty. There were one or two places in the world where the markets did have to close, but that's because they still had a lot of face-to-face interaction in the chain. But generally speaking, we managed to ensure that there was an acceptance in public policy circles that markets should remain open. We had another discussion about short selling, which we're in favor of. That went quite well because although some countries introduced bans on it, many didn't. But as part of that, there was a lot of concern about supporting the markets as well. And in essence, because the Federal Reserve Bank was concerned about the state of the credit markets, they bought ETFs. Now, why were they concerned about the credit markets? Well, because credit markets are always vulnerable to changes in mood. And when credit markets go bad, banks go bad. No matter how much capital they have, banks go bad. And then you have trouble, not just in the credit system, but more broadly. Part of the strategy was to help those credit markets by buying bond ETFs. Very similar to quantitative easing, very similar to what we'd seen after the 2008-2009 crisis. So that included the purchase of corporate bonds. And I'm making a lot of this because I think it just signifies pretty clearly that the ETF, even in the bond space where it's relatively small, is a significant part of the landscape, which is why you saw the Fed. And, okay, they only bought 8.5 billion of ETFs, and they bought bonds as well. But still, the symbolism of that, possibly the most important central bank in the world, going in and trading in the ETF market shows you how far they've come. This was under the Secondary Market Corporate Credit Facility, for those who want to look it up. And it's been wound down since then. It was always intended to be a temporary measure, but one can assume that next time the Federal Reserve is worried about credit markets, perhaps, let's hope it doesn't happen, but we've had some interesting developments in US banking this year. And by interesting, I mean some pretty, potentially quite serious insolvencies in the banking world. One must assume that there, at least, there will be the possibility of future purchases of ETFs. They did set some important parameters in this. The maximum holding in any one ETF was 5% of that ETF. So to protect their own liquidity position, they did that. There's a very good article about this on a website run by somebody called ETF Stream, which I've mentioned there. So if you want to look up the details, feel free. I mentioned that the ESRB has looked quite closely at this market. This was this question of whether or not ETFs might be systemic in nature, or at least that was a major part of the focus. The idea is that, the theory is that if the ETF is big, what happens there can create big movements in the underlying markets. As I've just said, it seems pretty clear that it's the ETFs where the price formation is often happening. In any case, it turned out that that ESRB paper found that there was really no case to answer. It was one of these hypothetical what-if questions. You hear some people say, well, what if the ETF trades when the underlying is not trading? Like my example earlier, what if you've got something listed in Warsaw and then the US stock market's there, and maybe that's a bad example, maybe in Asia, and you close and then there's been a big build-up of selling interest. Can that play out? But then you then get into questions of how much that impact actually is, and I'm going to come to that in just a minute, the interplay between the ETF trading action and what's happening in the underlying. The Central Bank of Ireland in I should just add that the size of the ETFs is still relatively small. It's been growing hugely, but it represents somewhere between 4 and 13% of the equity market. It's equivalent to that in terms of size, and a much smaller percentage equivalent of that in bonds. Those figures actually come from, it's my point, but the figures come from iShares. The Central Bank of Ireland in 2017 did a pretty much descriptive report about all sorts of issues, how the dealing works, risk factors, the characteristics of ETFs, liquidity provision. You can look those both up as and when you wish. Now, meanwhile, in the US, we've got an interesting debate going on, particularly about the extent to which ETFs should be allowed to be very creative in terms of their underlier. And as you're probably aware, there's been a big debate as to whether or not Bitcoin is an appropriate underlier for ETFs. There have been cash Bitcoin, not Bitcoin futures, but cash Bitcoin ETFs in Europe. They're being launched, not exactly regularly, but they come along every so often. In the US, only Bitcoin futures are permitted. And Bitcoin futures themselves are naturally subject to pretty close regulatory scrutiny. The CFTC wants to know about those. And the way that exchanges reassure the CFTC is to say, look, we take prices from a number of different price formation venues in Bitcoin. So to establish the spot price relative to which the future is pricing, they make sure they take a range. They don't just rely on any one venue. And that's to avoid any issues with potential misrepresentative prices or possibly manipulation. Recently, this year, the US courts said that the SEC had failed to do its homework, or at least failed to show its work, in the case of Grayscale, which is a crypto-focused organization. And this was in August of this year, the Court of Appeals. And the judgment said the SEC was arbitrary and capricious not good words, because it never explained why Grayscale owning Bitcoins rather than Bitcoin futures affects the ability to detect fraud in the spot market. So basically they're saying you can apply the same logic to ensure that the price you have for Bitcoin is clean. Now, we'll see whether the SEC accepts that and says, yeah, come on, bring in all your Bitcoin, cash Bitcoin ETFs. But for the and there's a lot of speculation that they will do so early next year, but we'll see. We'll see. On that note, I'm just going to finish with a few remarks about market dynamics. I promised you something about the extent to which what happens in the ETFs can influence what's going on in the underlying. I've said that sometimes, particularly in bonds, the price formation is more accurate, more clean, more up-to-date in the ETF. But you have to bear in mind that a lot of trading in ETFs is, I'm holding an ETF, I sell it to you. There's no change in the stock market. There's no need to buy or sell the underlying shares. Just changing a package of a holding. Estimates say that creations and redemptions run at about 6% of the trading that happens in ETFs. So you trade 100 of ETFs, there's only 6 of creation or redemption. It's not 6% of the stock market, it's 6% of what happens in the ETFs. So there's some figures from my friends at NASDAQ. They say something similar. 9 out of 10 trades in the ETF result in no buying or selling of the underlying stocks. It's a pure transfer of a portfolio. Quite efficient. NASDAQ.com articles, if you want to see, they have a interestingly titled article saying, are ETFs eating liquidity? They also comment, actually, that turnover in shares in the US has increased more than turnover in ETFs. So stock trading, it's a relative number. So daily stock trading increased by 177%, or $160 billion daily, at a time when the market cap only increased by around 100%. ETF liquidity has increased by over 1,000%, but as a proportion of the increase in market cap, it's smaller. The market cap has grown by even more than that. So yes, they're a tradable thing. People do trade them, but there seems to be quite a lot of buy and hold in there as well. So you're getting maybe the best of both worlds in policy terms. You can, again, look at the figures and see for yourself. I wanted to come back to the point about the INAV. I'm sorry, I should have mentioned this earlier when I was talking about it in the context of the BIS report. We said in our response to IOSCO earlier this year that the WFE views the INAV as an additional resource over and above the price formation contained in the ETF itself. The INAV is the indicative net asset value. You can supposedly calculate it by looking at the price of the underlying, assuming that price is accurate and not stale. We said that that is an additional resource over and above the price formation contained in the ETF itself. While it is possible that the INAV is the truest indicator of value at a given point in time, this is not necessarily always the case. The appeal of a given ETF may well be its relevance to a broad range of investors, making it a more effective indicator of price than prices in the underlying, particularly if the latter consists of individual assets that only trade episodically. In other words, if you don't have continuous trading in the underlying, you cannot be sure that that is, the best indicator of price. In calculating an INAV, it may therefore be important to take account of and flag as and when necessary any inefficiencies in the underlying market. I want to back up this point I've just made about ETFs creating relatively few share trades. This is the cumulative aggregate amounts traded this year in, I think, January through September, maybe October. In any case, it's there in the trillions. That's the cumulative amounts traded so far this year. The average daily net is about 1.9 billion, which is, as I said, less than 6% of ETF trading. That's the number of share trades created out of all of that aggregate flow of, 1.5 going on 2 trillion on the purchase side and just under 1.5 on the sell side. Another chart to show a similar sort of thing. This is from 2022. You see the futures in that left-hand column. Obviously, that's notional, so not an actual money changing hands amount, but it's the notional. The blue column is shares trading. The green column is ETFs trading, and that small green column right over on the right is actual creations and redemptions. This is just to show you that this is stable. That's the same number from about 2019, January, October 2019, same time. Again, NASDAQ is the source for that. And I'd just like to close with a few other issues that are around there. Retail participation, we're going to have a speech on that in a minute, has been a big factor here, I think. Although the growth in ETFs wasn't really dependent on, I don't think it was affected so much by COVID as trading directly in shares and in derivatives. There are issues around in some countries about the extent to which you should allow dividend smoothing in the ETF world. How much can you use inflows to smooth out dividends? That's getting some press at the moment. Generally speaking, it's accepted that for efficiency in the market, it's good if the authorized participant, who has the power to create and redeem ETFs, should also be the market maker. Creates a good incentive for them to actually participate because they can make a bit of money from the market making. Synthetics, swaps-based ETFs, one to watch, but there's some tax efficiencies in there, I'm told. More a European phenomenon, not that big in Europe at the moment, but out there. I mentioned coordination of circuit breakers. Some people are starting to wonder about what happens if different markets move to T+1 settlement in equities sooner than others, because you can have ETFs listed in more than one place, or ETFs referencing shares listed in more than one place. Might be one to watch. But there's the chart I mentioned I was going to show you, which is cumulative retail net flows. Again, from NASDAQ. They do some good work. That shows you everything except the blue is ETFs. So, and then the blue is stocks themselves. Quite an interesting phenomenon, Jacques. So in proper conclusion, I'd like to say I think that the growth in ETFs is pretty much organic. It comes from natural, understandable reasons. Public welfare does seem to be quite well served by them for the reasons I've set out. Happy to debate that. There's a very well-established superstructure around them. You've got the exchanges, you've got the market makers and authorized participants. There are statistics out there. It's a user-friendly market, I would say. And I would say that what all these reports are showing from the regulatory side is that there is an increasing degree of comfort having looked very closely at this market. And I would say that the big thing with ETFs is that instant gratification. You instantly get diversification, and that is supportive to the overall appeal of financial markets, particularly stock markets, bond markets to a significant extent as well, so that ETFs support the underlying, but also they offer a new dimension. So it's a win-win. I hope you found that helpful, informative. Thank you again for the opportunity to talk to you about this. I'll be around to talk with anybody who would like to have discussions. And I think there's a question coming in. Hello.
Yes, please. Marek Dietl, CEO of the Warsaw Stock Exchange.
So, Richard, thank you very much for a very interesting presentation. I'm not sure if you're going to subscribe to the statement I'm going to make in a second. That partially success of the ETFs was due to the more regulatory scrutiny of hedge funds. Agree, disagree? And to my question about the recent developments in the base point trading in the US market when SEC wants the hedge funds to be regulated as dealer brokers. Do you think it's gonna change it will be another milestone changing the landscape for bonds ETFs, or it's gonna be neutral? What is your take on this SEC idea to more scrutiny on the base trades?
I would agree with your suggestion that the way that hedge funds are great, right? But there are all sorts of issues embedded in there, including a credit relationship with the banking world, prime brokerage. So yes, I think that ETFs are somehow simpler and cleaner in many ways. So I think it's not really surprising that you see that difference. And your second question was about the bond dimension.
Yeah, the bonds trading on basis should be limited by the hedge fund. So that's the SEC proposal. So, and they want to, if you do the base trading on arbitrage between futures and cash market, and hedge fund will be treated like dealer broker, so more scrutiny, regular scrutiny. Is gonna make another tectonic shift towards ETFs, or what's your take on that?
It could do. I mean, yes, I think it's entirely possible. Of course, you could create an ETF that embedded the basis trade strategy, but that's another story. I mean, for me, the really curious thing about the treasuries market is how the dynamics of that have changed so much since before the 2008 crisis. And now everybody's saying, oh my gosh, we need central clearing in treasuries and all these other things as well. There's a lot going on there. And again, I think that, yes, you have to be right, that the cleaner, simpler mechanics of the ETF make it very attractive, particularly in these circumstances where you have complex and volatile phenomena going on in other bits of the market, other supposedly very safe bits of the market.
Thank you.
Thank you.
Some other questions or comments?
Oh, yes. Sorry, I should have allowed more time for questions. I beg your pardon. Sorry, next speaker.
So I wanted to ask, why buy an ETF indexed with Bitcoin when you can just buy Bitcoin?
Well,
I was always wondering.
I guess somebody else does all the trouble of buying the Bitcoin for you.
Yeah, okay, just it.
The other bit to this is, I mean, I haven't really talked much about inverse or leveraged ETFs. You can get single stock ETFs. And that is often because you want to create a leveraged product or maybe an inverse product or an inverse leverage product. Some of what people were doing on the VIX was inverse and leveraged both. So I think it's probably more those sort of edge cases, but you're right, you know, there's nothing to stop you, and it can be quite cheap to just buy Bitcoin as well. But then you have the question of which venue you buy it on, I guess. So if somebody's spreading the price across a lot of venues, you're maybe a little bit more confident that it is the price rather than a price. That'd be my theory.
I get it, thank you.
Thank you, great question.
One more.
Bittner, Polish Financial Supervision Authority. I would like to ask what do you think if it would be possible, because you mentioned that some mutual funds are turning into ETFs, and would it be possible for all mutual funds to turn into ETFs, and if not, why? What would be the biggest trouble? Thank you.
I guess in theory, there's no reason why they couldn't. It's not a question I've ever thought about. It's a very interesting question. I know a lot of people think that if everything was passive, where would the price formation be? But
They could turn into active. Active.
well, and an ETF in its current form doesn't have to be passive anyway. It can be, the holding will stay the same, but because you can trade in and out of it, that will still imply prices in the underlying. Look, you know, ETFs can do many of the things that mutual funds do, so I guess there's no reason in principle why you wouldn't. But I guess the effects would ultimately come down to the extent to which you have. I mean, I've talked about the ETF being a good form of indicating where the price is, but it's still useful to have active price formation in the underlying. And I'm guessing that the real reason, you know, I'm guessing that in practice that will never happen. In theory, you could go all the way there, but it just seems that people are still reasonably comfortable with the classic mutual fund as well. Interesting question.
Okay, so
Okay,
thank you
so
very
much for the
much
questions.
for that interesting presentation.
Thank you.
And now I would like to invite you to a short coffee break. We will be in 10-15 minutes. So for those of you who are watching us online, please stay with us. Okay, so now we can start the second part of our event. And our second speaker, Marku Kaustia, professor at the Department of Finance from Aalto University. Please join me on stage and enjoy the presentation about personal values in households, stock market participation. Warm applause for our second speaker.
Thank you. Also very thrilled to be here. So my research background is in what people at least used to call behavioral finance, which is an approach that sort of takes seriously the research in other social sciences, namely psychology, and tries to apply a more realistic version of human behavior. What do we know? How do people actually make decisions? Because people are not the rational, standard economic, fairly restrictive way to model human behavior. And this started already something like 30 years ago in the 1990s, and I was got on board of that, and a lot of my research was also utilizing actual trading records data of individual investors. And one part of that earlier part of the research was to basically document and show the mistakes that people do in trading and in investments, and the way that they deviate from the sort of rational economic assumptions. So in this talk, stock market participation is the centerpiece of the behavior that I'm going to be looking at, and that just basically means whether a person has any stocks. And we will talk about direct participation or indirect participation, population averages, what percentage of the population is holding stocks, and we'll try to make headway in understanding of why and why not people don't invest more in stocks. So actually, I'm going to now conduct a survey here. You are not the general population. I think maybe stock market participation percentage is higher here in this audience, but let's see, show of hands, who in some way or another invests something in stocks in this audience? Not everyone, but some higher percentage than the average in Poland, which I think is kind of low compared to European countries, other countries. It's probably around 10% or something like that in Poland. The personal values is a way to understand sort of a higher hierarchical needs and wants that can affect investment decisions. Similar to, maybe you've heard of the Maslowian hierarchy of needs and wants, of the basic kind of things that humans want. So you start from a very low level of things that you want to have. So you want to have shelter and warm. At some point you may need water. A little bit later you may need food. These are the basic needs. And once those are kind of, you're happy with them, then you can start to go with the higher level types of wants and needs. And at the very high level, you have kind of the highest types of needs at the hierarchy are things like maybe feeling respected, feeling a sense of belonging, self-actualization, creativity, and that kind of things. So this is always very useful to understand what your customers or your stakeholders, what do they want? And a basic premise for the stock market participation is that to be able to do that, you of course need to have the low level secured. You need some wealth, some capital to invest in. Whether that's not there, then the values and attitudes don't matter much. You need something to start with. You need some basic level of financial literacy. And once you have those, we'll actually see that still people who would have the resources and the means that you typically think are needed to have stock market investments, still a very low percentage of those people who could invest in stocks actually do it. And that is the stock market non-participation puzzle. The top 5 household investment mistakes, and one could always quarrel a little bit. What is the top 5 or top 6 or whatever? So there are more. There are more investment mistakes, but just listing those, there is a pretty high consensus that at least the number 1 there is in a correct order. Otherwise, you might debate a little bit of what is the top. But the stock market non-participation, that is regarded as the more widespread investment mistakes that has the biggest impact on the individuals themselves and the society at large. So a mistake to invest is not investing at all. So then you can't make the other investments. I suppose that's the positive of it. But this stock market non-participation is something that we're going to look at. What drives it in this presentation, the lower level things. And then I'm going to argue that these higher level needs in the hierarchies, things like personal values, can then explain why some people don't invest in stocks, even if they would have the wealth and the education and sort. The standard economic model basically says that almost everyone should invest in stocks. But if you don't have the wealth, well, you can borrow. That's the argument. That is why we have capital markets. So not 100%, but it should be fairly high if people behaved according to rational economic models. Your participation rate in the stock market in a developed environment should be very, very high. But in fact, it's actually in many countries closer to 0 than it is to 100, where economic expectations would suggest. The stock market participation puzzle, or non-participation, that's more like the puzzle, people not participating. I'll show you some statistics. This is a little bit of older data, actually ending in 2000. This hasn't changed that much though, so I'll show you some updated data. This is the participation rate in different countries. And here we have the direct participation, which is holding stocks directly. It does not account for mutual funds, ETFs. If you account for those, these numbers will go up, but maybe not as much as you would think. Well, I'll look at that also. On the lower level, countries where it is already low, then counting in indirect participation increases them almost twofold. But when it's high, like in Australia, it doesn't really increase that much if you include indirect participation. The rates have increased somewhat in some countries in 20 years, but not that much. So really clearly we can see that in no country here would that even reach 50%. So it's really closer to 0 than it is 100%. In some countries, we'll see actually here a little bit more recent data from the Survey of Health, Aging and Retirement in Europe. A couple of countries there and 4 different waves of the survey, so we can see that it has increased a little bit in some countries, but then in countries where it's very high, Sweden is the highest, where it's almost, one can say that at least looks a little bit more like the standard economic model would predict, although even there not nearly 100%, it has actually come down a little bit. So Poland is actually also part of this data. I use this to demonstrate the effects of personal values to you in a minute. But here, it's only the countries are shown that are part of all the 4 waves. And similar to Finland, Poland was not part of all of these 4 waves, so unfortunately don't have those countries here. But Poland is among the lowest level participation levels, so Italy, Estonia, something like that. And then we have direct participation separately, which is obviously lower still. Let's look at a time trend. This is US only, but also one could then wonder that, is this something that people are just slowly realizing that it would make sense to invest in stocks and the participation rate would be trending upwards? It is in some countries where the rates are low, so they are increasing as you could see, but where they already are relatively high, not really increasing anymore. So it is not converging, for sure not converging to the 100%, and it just goes up and down a little bit. And here, this is including indirect, all forms of participation. Okay, so what explains participation? And we are actually interested what explains non-participation, because then we can direct policies and financial literacy and other kinds of campaigns if we understand better why and what types of people do not invest in stocks. So first, a big picture into the type of factors that we have found to explain participation. Institutional factors, here they are actually captured by what is country fixed effects. So we do not measure the institutions here, we just look at the differences between countries. There's 19 countries here in this analysis, so you can think of this as taking the same kind of individual, holding constant things like education and income and risk aversion, and comparing same individuals in different countries, and you still find that what country they are coming from matters a lot on the whether they are investing in stocks or not. You can think of these as cultural and institutional differences between countries that are not explained by education and income and such important things. So roughly about a third, the pie tells the explanatory power in the model of predicting who is investing in stocks and who is not. The model as a whole does a pretty good job. The R-square is 29%. That doesn't necessarily tell you if it's high or whether it's kind of intuitively not so easy to understand. But if we take two individuals, where one is investing in stocks and the other one isn't, then this model is pretty good, very accurate in predicting who is the stock market participant out of those two. And the what I call here traditional factors, wealth, risk aversion, education, liabilities, income, they explain almost half. So traditional things that standard economic model would say are important, they are important. But on top of that, we have these behavioral factors, which have, as I mentioned, as a result of understanding or trying to incorporate human psychology into understanding investor behavior, has suggested several variables to investigate. And these variables, which here are sociability, cognitive skill, religiosity, health, political orientation, trust, body mass index, these are actually coming from individual studies. So for each one of those factors, there is some study out there that only looks at that factor. And we take all of the literature. We don't invent any new factors here. We try to take all of them in the same paper, put everything in the same model, plus do it across countries. So you might be interested in kind of why would religiosity, for example, have a negative effect on participation, and that is where we are coming to this personal values question. We'll look at some of these variables more closely next. The value expressive hypothesis of stock ownership. This means that not unlike consumer choice, where things you buy, for example, the kind of clothes you wear, are partially influenced by your personality and your values and attitudes. So also for stocks, do you invest in stocks? Once these other factors are accounted for, the basic level things, how consistent is stock investing with your values? So I'm going to still be talking about that binary decision, yes or no, invest in stocks. And later I will actually take a look inside of the portfolio. If you invest in stocks, then what kind of stocks? And obviously ESG is something that's kind of aligns nicely with this values type of a hypothesis. What kind of a investment strategy person has. So the value expressive hypothesis says that these types of things matter for investment choices. Here's an early paper we published on this. It's called what we dubbed the stock market aversion. So what this means is that in addition to classical things like risk aversion, which should determine how much you invest in stocks, wealth, income, all of these things, you may have some negative sentiment toward investing in stocks. And we captured this with political preferences. One could think of other measures also, but the measurement is sometimes difficult, and you can't have direct measures of values and attitudes in this big data sets. So we use very, very large data sets from different areas here, and we can, the political preferences are nice because you can sort of objectively measure those. You can get those directly for politicians. That's very visible. You can do an exit poll, asking people who they voted and ask about their investments. That is what we did. Then we also actually do it at the area level, at the zip codes, where we don't need to ask people who they voted. We have the results. We have the voting results. And we actually know from registered data who is investing in stocks. So we have one data set where we don't need to rely on asking people. We can just observe. However, there we cannot do individually. You cannot directly observe individually how people voted. That is one fundamental property of elections, that it's secret, actually. But we can observe it at the level of the area and find that left of center political preferences explain non-participation. So given two individuals that are otherwise similar, same education, same financial literacy, same risk aversion, if you are more market-oriented, center to right political preferences, you are more likely to hold stocks. So the stock market aversion idea is that many people that have the means of investing in stocks still don't do it. This is really more of the puzzle of the stock market non-participation. While it's more understandable that people that just are in a stage of life where they don't have the basic means of investing in stocks, they don't do that. But the puzzle is that actually started already in 1954. The New York Stock Exchange wanted to find out why still people are not investing in stocks among populations that they would think all of them would invest in stocks. And they went studied lawyers and doctors. They selected those groups who in their opinion, would almost all of them have the means. They would have like 100% participation. But and the participation rates were high. They are higher among doctors and lawyers than they are in the general population. But then why still in that population some people didn't invest? What emerged was this vague sense of prejudice. So this is an early idea there, and we then took that and developed variables to measure that. Okay, so we find that left of center political preferences discourage stock market participation. Now let's take a look at those driving factors one by one. What I already mentioned, what are the relative effects of different factors, and then also come back to a more big picture thing, the hierarchy, the base level drivers and the higher level drivers. So this is from our study across Europe, where the base rate, this is the average of across all countries, part of this study, 19 European countries, that's 27% participation. And as you saw earlier, this is higher in some countries and lower in some countries. The effect sizes in our model, which is predicting who is investing in stocks and who is not, what that means is that a 1 standard deviation increase in a factor, for example, education, measured in years, the standard deviation increase in education has 3 percentage point increase in the probability of participation. So 27 base rate would go to 30%, 27 plus 3 for 1 standard deviation increase in the education. So education is obviously very important. Male gender effect is still there. Men invest more in stocks. And remember now, this is all of these factors are together, so this male gender effect is not explained by a higher income, for example. This is all taken into account. It is also not explained by risk aversion, because this is also known that males typically have a little bit more of a risk-taking attitude compared to women. But that's also accounted for, so it's some kind of a cultural effect. Income obviously is a positive determinant, and it's a good benchmark. These gray bars here are what you could think of more standard factors that even in basic economics you understand that this would actually affect the participation decision. And then the blue ones are these newer or behavioral type of factors. There's quite many that help us a lot explain who is participating and who is not. If we stopped with just the gray bars, we would have a much less explanatory power. Of course, it becomes harder and harder to make more and more progress by adding one more variable to explain more. But looking at these new types of factors is important because that gives us an idea about who is not participating, what we could do. For example, if sociability is a strong positive factor, then if you have financial literacy classes with peer effects, you will have even a double effect. It increases the networking and it also increases the knowledge. IQ is here, financial literacy would be one subset of that, but even just basic cognitive ability is positively explaining stock market participation. So it's a good idea to invest in stocks. Also from implicitly, you can see that smarter people are more likely to do that. Optimism, it's pretty clear that more optimistic personality, you may have a higher return expectation or more optimistic about the economy as a whole. Health, better health is a positive, so conversely, lack of or poorer health, that is a negative effect. Generalized trust, this is just based on how trusting people are on average. You can also ask about, try to find how much people trust the stock market institutions like the stock exchange and brokers, and this is pretty correlated with the general trust also, so of course that kind of makes sense. Then we have this right of center variable that I showed you in the earlier paper that we had. So more market-oriented, pro-capitalism type of values go together with a positive effect on participation. Body mass index. I want to highlight that for each of these factors, there is a study that looks at one factor at a time, and now not all of these factors are necessarily important if we put them all together, but here you can see the important ones. So we're not even arguing why a certain variable should be there, but this study, I often get questions, why would you have body mass index there? So it is actually something that is correlated with self-control, so related to savings, and it seems like indirectly also, if you have a better self-control, you have a more tendency to save and such. Religiosity is negative, so more religious is a negative effect. Doesn't matter on what religion it is. There's a little bit of differences among religions, but two of these variables are more directly about the values, personal values, and those are the right of center, that's the political opinion, and the religiosity. The others are more personality type of factors. Then there's financial hardship. If you experience financial hardship before, it may leave a negative experience of financial things in general. Of course, you might think that financial hardship also signals lower wealth, but remember, wealth and education, income is controlled for here. So there is some kind of an lagging effect if you had financial hardship many years ago that still makes you cautious, probably. Regarding risky investments. Now let's look into two of the strongest new factors. So here is still the same slide. I just kind of start with the sociability and IQ, since those bars are highest. Those among the behavioral variables have the biggest effects on stock market participation. So we can actually break it a little bit into what's going on. So you can have different types of sociability. We can measure that social behavior in different ways. Actually, if you are involved in a religious organization, that has zero effect. Sociability in general has positive effect, but maybe this makes sense because remember, religion as such was a negative. So if your social scenes are about religion, then that may also show that the net effect is zero. You get a positive from sociability, but you get negative from the religious attitude. Political orientation, a political organization type of sociability, that's a plus. Now this is not measuring only, actually it's not measuring your political orientation, because this could be any kind of organization. It's just a social activity, social activity. Voluntary work, education and training, sports and social clubs, very strong effects if your social circles involve that activity. Very interesting, I think, that education sociability is so positive even after controlling for education. Education in the leftmost bar is just your education level, and then being involved in education and training in a social way, that's a very strong effect on top of that. Sports or social club type of sociability is also very strong. And remember, we are also controlling for health already, so this is on top of those effects. Then when we look at IQ, this can be broken into 3 different parts. Numeracy would be your calculation type of things, analytical reasoning. Interestingly, that has a 0 effect. Fluency also has a 0 effect, and it's the recall ability, actually, where that is driving the IQ effect. Working memory type of things. Recently, psychology has placed even a more, there's more findings to support the idea that this working memory capacity to process things is actually a very important facet of IQ, and this seems to be where the effect is coming from. But then all of those facets of IQ do have an indirect effect. Even if they don't have a direct effect, they are all associated by reducing risk aversion. So higher IQ people are more risk-taking on average. So this a little bit like understates the effect of IQ, because we are already measuring risk aversion, and we know that the risk aversion should be and is a very strong determinant negative effect. So if you are more risk averse, you're less likely to invest in stocks, and the IQ effect also indirectly comes through from there. Okay, now this brings me to the hierarchy model of household financial decision drivers, values and attitudes. What is their significance in relation to the more lower level things? So what I was, the basic means, background risks, those can be measured by wealth, income, and health. Medium level things that when you have the wealth, you have the income, you're healthy enough, you still don't invest in stocks, then this may be due to lack of education, cognitive skills, sociability. But once you have those and you still don't invest in stocks, then the values and attitudes can be here, and seems to be what then explains non-participation. Political orientation and religiosity are the measures we use for that, but one can think of different kinds of measures of values and attitudes. It's just all dictated by data availability, basically, and working in understanding why people don't participate and how you would get them to participate. It's very good to know where people are in terms of this hierarchy level. This, of course, varies also by the type of financial products and services we want to apply this to. So far, I've just applied it to the idea of binary participation. Do you have stocks or you don't have stocks? You're out of the market. And one could then think about, depending on your business, where you're coming from, whether you're a regulator, a financial advisor, or asset manager. So would be good to understand where, if you work with retail clients, where they are, and of course this can vary. For some, it is basically the wealth, the basic level is what determines their financial behavior, and for others it could be the higher level that determines their behavior. Okay, now I'm going to think about inside of the portfolio, what happens there. So if we look at people who invest in stocks, you know, this is the minority, but what kind of portfolios do they have? And as mentioned, ESG is a natural application for these values and attitudes. We have an upcoming presentation coming from that, so I'll just take one example. And study that I really like in this regard uses what is called a sender-receiver trust game. So value-expressive portfolio composition now. We talked about value-expressive, whether you invest in stocks at all or not, and now it's what kind of stocks. The sender-receiver trust game, actually I'll show that later because I'll show examples, is a really great measure of pro-social behavior, where you can really see if people put their money where their mouth is. So how that happens is that You do these experiments with real money where two people are paired, but it's anonymous, so you do not know who your pair is. And then both are given €50, and the first person that is designated or randomly assigned as a sender can decide how much of their own €50 they're going to send the receiver. And the trick here is that this is a very strong incentive for cooperation or for sharing, because the experimenter actually triples the amount. So if you send 10, the other person actually gets 30. So this is you can think of it as an economic growth, basically growing the pie. If you trust people, you cooperate. But then remember, they don't know each other and they will not know each other. So this is just based on whether you trust. Why would you send money to the other person? Well, they will get more, so there's a big return on this investment, triple. But then the other person can send back. So you can get the maximum pie by sending all of your money to the other person, the triples, and then you hope that they would also send it back. What the second person does, the receiver, that's a really good, true measure of pro-social behavior, because you don't have to send anything back. You can just keep all of the money that the poor sender sent you, and you don't know each other, so you cannot, you wouldn't even have any ill will. So let's just look at some examples. And I want to go through this because in the end, actually, this measure, how people behave in this game, was matched to actual holdings, and we want to see how this is related to what kind of a portfolio, what kind of funds they have. This is a little bit complicated, so I'll just show you some examples. I think you get an idea. So both are given 50, and A doesn't have to send anything, then it stops. You can walk away, both walk away with 50, but here in this example, A decides to trust B, and obviously hoping to get something back. So A sends 20, B receives 3 times 20. That's kind of the big return on investment here. Economy grows. So they now have 110. The B has their 50 that they had in the beginning and now has 110. B decides to return 40, being a nice person. Returns 40 to A. And actually B calculates it so that they know that, okay, I'm going to return 40, so both of us have 70 in the end. So we split the pie. Basically, A's action decides how to grow the pie, if at all, or maximally. Here they kind of go middle of the way. They don't send all of the money, but also they send something. And B then decides how the pie is split. If B wants to, they can keep all the money. Or they can send more back to A, they can send some of it back. And the B's behavior is then this measure of pro-social behavior. Do you do the right thing? Because that first person gave you the money, that's why you got richer. Do you want to share that profit? You don't have to, but do you do that? And people are different here. So some people keep all the money and some people send some money. Okay, let's look at another example. This is the maximum now. So A fully trusts and sends all of the 50 to B, so B receives 150, has 200, and now all of the pie is on the side of B, and B decides to be the nice person and splits it evenly, sends back 100 to A. You could, of course, send more or less, or just the same or nothing, and here is a kind of a little bit of nasty example where B just doesn't send anything back. Okay, now, we can ask people how much do they want to do the right thing in their consumer choice, but it's cheap talk. You can always say whatever, basically. But this is an actual measure where that affects your wealth. You basically give up some profits for just thinking that this is the right thing to do. I got this money because the first person was nice, so I'm going to share that. And now this study looks at Dutch investors, 600 investors, where they actually made them play that game for real, and they match it with their mutual fund holdings. What aspects of mutual fund holdings am I looking at? You can probably already guess: socially responsible investing. So now we can look at people who are nice and split the money evenly and compare them to those who either send less or just don't send. And the people who do split the money evenly are twice as likely to invest in socially responsible mutual funds. Even the people who keep more money themselves have a 16% have ESG funds. So this is very high. Holland is one of the countries with the highest, retail investor participation in ESG type of products. So numbers would be lower in other countries, but the effect is twice for the pro-social people. And remember, there is no social element per se because you do not know the person. It is purely about your preferences. The other person, the first person, does not find out. Nobody will know if you keep the money. It's just kind of, you can think of it as do the right thing type of a measure. Outside of, also in this study, they show that the investment into ESG mutual funds is actually not driven by return expectations. Could be. I mean, you could have a belief where ESG funds, you think that it's going to produce abnormal positive returns. Some investors have that belief, but by and large, this is not what is explaining actually the incidence of investing in ESG funds. Much bigger, decisively bigger effect is coming from this as measured by sharing the money, the pro-social behavior. Okay, so that was now value expressive effect within the portfolio. Next example is sin stocks. So what are sin stocks? And I just wanted to get the definition that Google provides. So it says stocks of companies that are involved in businesses like gambling, tobacco production, adult entertainment, alcoholic beverages, and gun manufacturing. I want to take this example because also the preferences are changing, and what is considered sin and what is not obviously depends on each person, but also there are trends in time. And if you look at the gun manufacturing or defense, that is something that even a couple of years ago used to be like a no-no type of an investment, but now people are actually changing their behavior, retail investors and also professionals, thinking that defense, I mean, you got to have defense. So investing in defense is being kind of disassociated from the traditional sin stocks. So that is also a value expressive thing to do. It's not necessarily whether you invest in defense stocks doesn't necessarily affect anything, so you cannot increase your own security by doing that, but it can also be something that is consistent with your values and attitudes, and you want to do that because of that. The other thing that comes up is already 15 best sin stocks to buy. That comes second, so this is also interesting to know as sort of anti-ESG movement because in finance, we usually think that higher return comes with higher risk, or vice versa, higher risk means higher return. So there is an investment thesis out there where these sinful companies are riskier and therefore actually provide higher returns. So some people go against ESG and do that. Okay, now finally, the last topic is a feedback effect. Does your investment affect you? Your values and attitudes, perhaps. So far, we talked about how does your attributes, your income, your risk aversion, your values, how do they affect how you behave as an investor? But there is also a feedback effect where your investments affect you over the long term. Bidirectional causality. Some examples. Engels says, a worker who owns a 1,000 thaler house is no longer a proletarian. So here is when, in his opinion, ownership changes the values and the status of the person, and you cannot have certain values if you are too rich or in some sense. A more recent example is the Bush campaign, presidential campaign, the Ownership Society agenda will lock in millions of voters by changing the incentives of politics. What that means is that they did a series of policy proposals that would make it easier, that would basically increase the stock ownership rates in the US. And what they're thinking here, they're basically saying that they believe in this feedback effect. If you have more stock owners in a society, then later on, you will have more pro-capitalism type of values and attitudes. It's consistent. They believe that you could maybe change how people behave by providing these incentives. Okay, so let's see. We did a study on this, and we really had to think, how would how would you really measure this? Because once again, you can ask people things and they're not, first of all, they are not necessarily always honest, and even if they are, they don't really understand their own behavior, and they can't tell you like, did it affect my values that I'm holding stocks? I don't know, it's kind of hard to tell. So we measure this in a naturally occurring data. Think about how you could study that. If you look at people who are investing in stocks and you find that those people have more pro-capitalism values, does that mean that owning stocks makes you pro-capital? No, not necessarily. In fact, I've argued that being pro-capitalism is actually a factor that makes you buy stocks. It's one of the marginal effects there. So what you get is reverse causality. It would be very hard to study by just looking at people who already have selected a path where they invest in stocks and people who have not bought stocks. And you are being sorted, you are separated by different values and attitudes already. So the perfect experiment to study this would be basically actually to assign stock exogenously to people that don't have stock. Stocks, you just kind of hit them with stock. And then you see whether that changes their behavior. Because then the people are not selected themselves to invest in stocks. You basically randomly assign stocks to them. And you can, this is a little bit like a medical study where you compare a effectiveness of a drug. You randomly give it to some people, and then you see what is the causal effect. So how we do that is an empirical test of this feedback effect. Can stock ownership change you? And preview, we find that yes, it can. So here we have an average individual. Think about just kind of what do they have in their mind, some things they're currently thinking about, and they are a stock market non-participant. So they're not thinking about stocks. They're thinking about other things, maybe lower level hierarchy things. And now what we do is we hit them with a stock. Oh, what's that? So first what that does is changes their attention. They become aware of a stock. And if they are aware of a stock, they may start finding out information about stocks. And that over the long term may change their pattern of information acquisition. They may be exposed to different types of media, different types of sources that they weren't before, and that can affect how they think, how it can change their attitudes to be more pro financial markets, for example. How do we do that? How do we do that random assignment? So the data comes from Finland, where there were a couple of local telecommunication companies where you had to buy their share, basically, to have a fixed landline. This was in the 1990s. So it had nothing to do with stock investment. You had to get the landline, you had to participate in that. Some of them chose to actually convert from these mutual companies to publicly listed companies, but not all. So this creates an experiment where tens of thousands of new shareholders were created because their phone share, or something that they just use for having a phone, this was a little bit before the cell phone times, all of a sudden they find that this company is listed in the stock exchange. It makes price discovery salient. You can see that, oh, this is actually a security. It has a price that goes up and down. What is this? It's a stock. And then we can compare behavior in areas that are very similar and right next to each other, actually. We control for the type of population. The difference is that on one side of the border, there was a phone company that converted into publicly listed shares, created many new shareholders in that area, and in the other part, there wasn't. Quasi-natural experiment allows causal inference. Conversions of mutually owned firms to publicly listed companies in the 1990s created tens of thousands of new stockholders in Finland. Okay, so now we understand the premise of the experiment here, what is happening. It's pretty close to random assignment. From the perspective of these people, they didn't choose that the company that provides phone services would get listed. It just happened, they happened to live in an area where that was the case, and then we control for the differences in the area. Sometimes the values of the stock was pretty high. This was, I think, there were different companies, but at least in one case, it was something close to €8,000 already, and it went up quite a lot after listing. So that you can think of as the incentive to find out that all of a sudden you have a security that goes up and down in value. So what is the outcome we then study? Because we're interested in, does that change you? Does that change your behavior? So once again, we take the variable that we talked about before, political orientation. Why? Because we can measure that at the area level. We have the vote shares for right of center, center and more market liberal parties, and we find that in those areas where new shareholders were randomly created, the vote share to center and right of center parties increased in the next elections over time. So this is consistent with the idea that the random creation of these shareholders changed how their values and attitudes. We don't know why, but the plausible mechanism is that they started to learn, they changed their information acquisition and they started to learn about stocks and the stock markets. Perhaps becoming at least a little bit less prejudiced or negative toward stock markets or its institutions. You might think some alternative mechanisms here, but we actually rule those out. Is it a wealth effect? They just became wealthier? Actually, the conversion into publicly listed shares didn't directly change their wealth right then. Later in the stock exchange, it went up and down, so it has some effect, but we also calibrate this and find that it cannot be explained by wealth. Is it liquidity? Now that you have, instead of a phone share that you have to hold, it's decoupled. You no longer need this for the phone line, and it's more liquid form of wealth. Actually, where people sold their shares, which would suggest that they benefit from this liquidity, this is not related to the voting patterns, so it seems like it's not a liquidity effect. Property right, the ownership actually didn't change in the conversion. Tax effect, the tax burden increased a little bit, but also a complicated calculation just shows that really negligible. So those alternative explanations that could also affect their behavior seems like it's not the case. So your investment can affect you. The assets that you end up holding can affect what you do or how you think beyond their effect on wealth. We found that a 10% increase in stock market participation increases the right of center vote share by 2.4%. So this is a 10% increase, not percentage points, but if you, in an area where, for example, let's say it's 30%, a 10% increase of 30 would be from 30 to 33. And that would then increase 2.4%. In the tight elections, this is a 2.4 increase is obviously a meaningful effect. So sometimes changing people's frame of reference can be easier than changing their direct incentives. If, for example, you want to educate people about why it's a good idea to invest in stocks, it can affect their values and attitudes. Okay. Then finally, I just want to leave with the idea that this values alignment in financial products and consumer preferences is something to think about also in terms of designing ETFs, mutual funds, obviously ESG type of products, but also other types of products and financial services. It all depends on what kind of clientele you're thinking about, what kind of a product we're talking about to identify where the clients might be in terms of to whom the values and attitudes might be important, to whom they're not, and which values and which attitudes, how you would measure that, utilize it in marketing, and also in product development. You would want to have products that match the values of the clients as much as possible. Okay, conclusion. So stock market non-participation is driven by wealth and financial literacy. Yes, these are, and other such classical effects, but also by personal values. The values matter for the composition of the portfolio as well. We saw the socially responsible mutual fund example. Then the investing in stocks has a feedback effect. So over the long term, it can also affect the society. What assets you end up holding can change your values and attitudes. And the alignment of values implicit in financial products with consumer preferences is, I would argue, increasingly important. Thank you.
Thank you very much for that interesting presentation. Great studies. and some very surprising results. There are some questions, yes.
Thank you very much for this presentation. So on one of your slides, you presented that the key factors that have that affect the stock market participation, and one of the biggest bar is male gender. And I would like, I'm very much interested in your view on the future. Whether do you really think that the gender diversification will affect stock market participation in the future? Because in my view, the world has changed, and now more women, they are really brave and they have their own savings. And in my view, more and more women would be also present on the stock market participation. But what's your view on this?
Very interesting question. These results are for the 19 countries as a whole in Europe, and this is different in some countries. We actually looked at this in Finland, which in many years is ranked the most gender-neutral country or gender-equal country in the world. I forget if it's now the second or first. It could be also Denmark, some other Scandinavian country. But Finland is the most gender-equal country, or at least about there. So actually in Finland, we find that men have more stocks, but once we control for things like this, the effect goes away. So here the idea is that male gender is correlated with risk aversion and other things, but it's still remaining. You can think of that as a cultural effect, as you mentioned, because we are measuring the other things. Education is still and income, and those are still correlated, and it remains. But in Finland, the male effect goes away once you control for those things, and it's actually a little bit negative. So this means here it's positive. It's not, being a male is a higher likelihood of investing in stocks. In Finland, if you take two people who have all the things equalized that we can measure, it is actually a little bit more likely that the woman invests in stocks. So I think, yes, in an environment, increasingly when you move to environments for greater gender equality, you will have less and less of this effect. In the case of Finland, this has even reversed, and other countries, to the extent they are developing to become more gender equal, I think you're right. Yeah.
Here.
Marek Dietl. I'm quite puzzled by your study on demutualization, if it can also go for a reform of pension systems. In 2014, Polish pension, there were compulsory capital-based pension schemes, and they were dissolved by the government, or half of the assets were taken away, and the rest of people had to reapply if they want to stay in the system. And have you witnessed studies? I'm not familiar with the literature, which also show what is the political attitude of people when they have this capital-based market pension system, pension scheme, versus if they have only solidarity systems, so defined benefit systems.
Right. So this would be at the country level.
Yeah.
Yeah. So it's that is tricky because we just have in a way like a too little variation, and it's a pretty decisive kind of a binary variable, this or that type of system, and I think you will find the countries that have the U.S. type of pension system are more right of center in politics. But I think this is like a long-term development, and we can't really tell which causality this is, what is driving what in the country level evidence. But of course, given my results, it could be that if we were able to measure it, the independent effect of that it could have this effect. But I'm not aware that people are able to isolate that.
So I was wondering, first of all, what age do people become interested in investing? That's the first thing. And the second one, which is connected, is what age should we start educating them if we want them to be financially literate and also invest in stocks?
That's a great point. This has been changing a lot recently. I'd say there's even a boom of younger and younger youngsters and even teenagers just getting more and more interested. Part of that might be driven by cryptos and those kinds of things, but whatever basically gets you interested in any kind of investment over the long term, at some point also increases your likelihood of diversifying and investing in stocks. So I think this obviously fluctuates a little bit up and down through time, but I think as a trend like fashion, I think it is really increasing, like this younger and younger people invest in stocks. Partially that is driven by parents and society realizing that financial literacy education is important. So I'm sure part of it is driven by also increased talk about these types of issues in schools. What age? What would be the right age? Yeah, you don't want to stress out kids too much about financial market stuff, but I think you can find kind of a playful things, maybe to follow some stocks and just think about products that you know in your everyday life, and just look at that. Oh, how is the stock doing? And so that could be start basically as early as possible when the kid can speak, basically.
Thank you.
Thank you.
Some more questions? Okay, I don't see. Thank you very much, Professor, for the interesting presentation. And now, last but not least, Linda Zelina Cross, CEO at the International Sustainable Finance Center, with a presentation, Rise and Rise on ETFs and ESG. Welcome on the stage.
Okay, so dzień dobry. Hello. So I always get the graveyard shift, as I call it. So either it's a Friday afternoon after a 7-day conference, or, you know, the last session before you get a break. But I'll try to make it as interesting as possible, since I think that my topic links the two different presentations that you heard earlier. And of course, it's ESG, something that you see everywhere, that you read about and see in the news all the time. And I'll try and dig deeper in terms of what does it actually mean, what is changing, and how to think about it. So first of all, we'll look at the wider context. So it's about the region that we're in, because all of this is relatively contextual. It's about also different types of instruments and how the ESG conversation is actually changing finance. Finally, we'll talk about the sustainability shift, because there is a major change in the regulatory landscape in the last couple of years. We'll talk about future of investing. So is there an opportunity in this region, or do we face certain risk? And finally, how do we navigate this environment? And I think there we will also talk about education and the roles of different actors in this space. So to start off, actually, we had relatively very, very positive early 2000s. All these countries, I'm originally Latvian, so we joined the EU. We had huge interest from different types of actors to invest in a growth region, in a region that was transforming. There was a lot of opportunity. And you can actually see this from the inflows of money. And you can see that Poland and Czech Republic did really, really well. Actually, the center that I run, the headquarters are in Prague. Why? It's a good question, because somebody said that the craziest thing somebody could do is start a sustainable finance center in Warsaw or in Prague. And I thought, well, what's the worst that can happen? So here you see that there's only 3% of the total flowing into the CE region. So this is still very, very small. This also speaks to the underdeveloped capital markets. And I would also say sometimes a bit of prejudice and fear from certain parts of the financial system. And that is linked to politics and a variety of other factors that we will look at later. Often we hear from a lot of people that, oh, this ESG trendy thing, it's like a nice luxury, nice idea that people have, but you know, we still don't know really what we're doing, there's a hidden risk in it, etc. Well, actually what I wanted to start with is that this is not a new idea. It's actually an old idea that's morphing into something that is changing essentially how people view the social contract. And that's very important because it will link back to the professor's presentation earlier. So first of all, it all started actually with a religious thinking about what money should do, what it shouldn't do. So it starts with sin stocks. Even now we have some investors who will definitely not invest in certain types of weaponry, for example, so cluster bombs. You see that in 1960s, you have actually civil rights movement that directly affects business and affects what people want to invest in. So there are large debates around pension funds, endowments in the US, etc. And then you see the climate conversation coming in. And this is where people realize that actually, oh, I might be using a keep cup, but if my entire pension fund and all of my investments are in something that I don't believe in, this is actually where you could drive impact. And of course, as you can imagine, all the activists and NGOs caught on to that. So now if you look at the COP conference, it's like a circus of different actors trying to argue as to what is the right thing to do. And you actually see here that what you start getting is a lot more concrete things. So we're starting to understand how to measure, how to standardize, and how to regulate this space. So growth of sustainable finance has been absolutely stellar. When we started the work on this with my business partner maybe 15 years ago, we still had to argue with different parts of the system, including EBA, etc., about what benefit this will bring. And now you see that the global growth of different types of ESG assets, and we will discuss what actually sits in this category, and EU ESG bonds are rising like there's no tomorrow, because there is appetite. So the market usually reacts to interest. And here you can actually see where the things get very complicated. So the US, or Western Europe, and the Western Hemisphere is actually the global headquarters of greenwashing. And the question is, why is this happening? Well, number one, you have a societal pressure and reputation pressure to do something. And the reality is we weren't that well equipped to actually know what to do. So often the people put in charge in trying to do something and react to these pressures were people in public relations. And I partially blame the third sector there, because to convince people to engage in the topic, the first line of conversation always was, but it's great PR. It's really good marketing. You should really do something about ESG. And that actually led to a lot of unsubstantiated claims. So people would do a small thing, create a big market campaign, and then be caught out. Recently, HSBC in the UK, the advertising authority, put a fine on it, because you can't argue that you're a green bank if only one tiny fraction of you is green. And here you can see some of the data in terms of, this is a very recent report. It came from RepRisk, which marries AI solutions on risk and also quite a good analytical unit. So here you can see what is the main misleading issue is the misleading communication, 63%. Interestingly enough, ESMA, the markets authority in the EU, wants to regulate now greenwashing. And the most interesting conversation that is happening there is, how do you prove intent? Because often people genuinely also want to do the right thing, but things are not perfect. So here, in the next 2 years, 2 to 3 years, you can expect a lot of thinking as to how do you document the thinking process, how do you document internally your sustainability initiatives, and prove that you really wanted to develop something or contribute to the market development. And here, most interestingly, is that most of the authorities across Europe actually encourage people to experiment and argue that you will not be slapped down with fines, etc. Please embrace the EU Sustainable Finance Framework, figure out your double materiality assessments, and start working on it. So I think for the next 2 to 3 years, people will have the wonderful opportunity to actually take it up and experiment. So ESG for funds in different geographies also looks different. So it's not a uniform monolith. There are some ESG metrics that are definitely material to all funds. If you're going to call yourself an ESG fund, there's definitely things that you should consider and not leave out. So one of the most obvious ones that we know how to calculate, we have so much standardized opportunity to use, is of course GHG and carbon emissions. It's also very interesting to use the ESG framework to start looking at what are the different impacts of market development. So what happens to a business model when there's increased electrification, when we start looking at the natural resource and biodiversity, prism, and we understand that actually we need greater dematerialization, that those businesses actually, up until now, have fared much better in ESG scores because they have a much smaller natural capital footprint. And also to understand the supply chain trends. We have seen great disruption to supply chains due to COVID and China-US relationship. Well, that actually has presented quite good opportunities for certain countries closer to Europe. And a very, very important part that I think people don't pay enough attention to is that governance, or that G, is absolutely everything. And that's something that is super crucial for this region, because from our analysis and from when we talk to partners, Refinitiv and some other data providers, it's actually, there's a lot of scope for improvement, which also means that the companies could score much higher when it comes to ESG ratings. It's a relatively misunderstood component of the ESG, because the G actually then oversees and manages the E and the S. So it's the foundation. Just like when you talk about P&L and EBITDA, this is also something that should be seen as the core. Then the how. So often we struggle in this space to marry the micro and the macro. So we have macro pledges of net zero, and then you meet people on the ground creating projects or running a business and arguing, I have no idea what I'm supposed to do here. It's all very theoretical, and it's all these big frameworks, it's all so much reporting. But here, actually, you see very real pressures that are helping people to think through this. The European Investment Fund actually has been working very hard on trying to encourage even funds in this region to consider new types of structuring of funds. So for example, we helped a private equity fund in one of the V4 countries to create an ESG-linked carry mechanism. And initially people were like, what? Anybody's gonna go for this? And it's like, yes, there's 30 funds globally that we interviewed that have done it. The structure of how you build it varies a lot. But the interesting thing is, after every single ESG-linked carry mechanism fund, the next fund actually learned something and improved the actual setup. So this particular fund will probably launch in Q2 2024. There's another one from London, a lot more advanced, a bit braver, you could argue, that is actually going to link the CapEx of all the portfolio companies to the EU taxonomy and then measure through that. And if they don't meet the target that they have set, they will forego their fee. So it's very interesting. You can have a sliding mechanism when you agree to say, oh, well, if we, for example, reduce the portfolio emissions by 20%, we will take 20% of the carry mechanism. So you can really play with the setup. But the point is that that setup immediately got EIF approval because they want to invest in that, and also a huge interest from Western limited partners who said, oh yeah, that's actually solid. You have solid measurements, solid setup, this looks really good. So they were able to attract capital from other parts of system that they hadn't tapped into before. Finally, sectoral approach built on ESRS. Eventually we will have sectoral standards as well. This is actually very interesting because there you can have a smaller set of indicators and the setup is much, much easier. So we are seeing also a rise of certain funds that target just one sector. So they're not trying to diversify particularly across different sectors. They've decided that no, they're diversifying through different countries, but they will keep a sectoral approach. And finally, we do have now quite a lot of reporting frameworks. And the main thing is to understand, number one, what do you need for your compliance? And number two, what do you need for all the other purposes that you might be targeting? And we will look into that in a bit. So I'm sure that most of you are already familiar with this. This is just a snapshot. We had a large project with Refinitiv, UNPRI, White & Case, and a lot of other actors. And we looked at the different types of data points that people are using. And up until now, the over-reliance of ESG has been, of course, on voluntary standards, voluntary disclosure, and very interestingly, predominantly on the existence of policies and certain types of procedures internally. But what we're moving to now is also trying to understand how do you measure whether these policies are operating in real life. So is it actually having any effect? because this is just mainly the effort. Apart from the E, where you can have direct measurement, and it's very easy to quantify, the rest of the parts are much harder to see whether they're functioning in practice. So for example, with one of our partners, we looked at a section of companies across the CE, and we tried to understand which ones have women on their boards. And then to understand whether the women on the boards is actually working. So is this policy of having women included actually having any impact? We looked at the minutes of the meetings. And then turned out that on average, the woman from 1 hour only spoke between 5 to 7 minutes. So then, is this policy actually working, or are we ticking boxes? And that's going to be the next big question to answer. So what is actually changing in the ESG space, and which I think, unless you're really deep into the conversation, you might not see, because if you look at COP, everything's happening and nothing's changing. That's pretty much what it looks like. But actually, things are changing. And I think that the most interesting part is, number one, there's a discussion, a serious discussion about transition. This was something that years ago we kept arguing that some regions are not ready for the conversation because it was led by a certain set of Western governments and Western experts. And we knew that the input coming from other parts of system was non-existent. And that actually led to what we would call too advanced approach from the get-go. If you talk about EU taxonomy, etc., it went really, really fast, and we would argue that the market didn't really catch up, or it at least didn't get an opportunity to feed into the debate. Instead, that just created a backlash. So the amount of lobbyists and amount of pushback from different parts of system was huge, and it wasn't very constructive, because none of these actors actually had the time to fully absorb the rationale, to understand what these experts are talking about. So it ended up being a bit of a political fight, which we then saw in terms of what happened with EU taxonomy, with gas and nuclear. Interestingly enough, so from all these efforts and different types of voluntary things, we are trying to integrate science a lot more. So I think never before have we had much more structured conversations with the scientific community. I've seen more people in finance actually reading IPCC reports, which is not always the greatest read, and also understanding the planetary boundaries and the tipping points of what's going to happen to the system as whole, because if you think about it as an investor, you kind of would care whether the system remains stable or whether to prepare for certain types of volatility. And finally, double materiality in Europe. So this seemed like a small thing that got pushed in, but that is huge, because that can change everything. And I will mention a couple of initiatives that work on this. So double materiality does look at the impact, not just from a risk perspective. The single materiality is the single risk perspective on the business. And with double materiality, you actually look at the business impact on the entire system, on the natural capital, etc. So all of a sudden, you start seeing how these two parts are connected. And from that, BlackRock has tested, together with Harvard, George Serafeim, his work is on impact integrated accounting. So all of a sudden, you integrate that impact into standardized accounting reports. Boom. If that's done correctly, you have actually standardized information for all companies worldwide. And for that, you'd probably initially would use ISSB. If we go back a little bit, it's interesting to hear much more net zero conversations. So again, initially it was very theoretical. Now, I think this month, we are in December, Chris Skidmore from the UK will release the net zero review in book format. So that was something that was commissioned by the Prime Minister to understand how you would implement net zero. What is the opportunity and also opportunity cost? So he was lucky enough to do a completely independent review, and finally it's getting published as a book. So I would actually recommend that as a reading, because it shows practically what you can do, how you can benefit from it, and what might actually be the costs of inaction. And that very neatly links to the inevitable policy response work, which also shows the cost of inaction, because there will be certain transition costs that people are not accounting for. Right, so the policy lens. I think the first presentation actually showed you a lot about the main ideas, like what is happening with the regulatory and policy framework around ETFs, etc. But it's also interesting to remember that in Poland, in Czech Republic, in all these countries, we are in Europe. So the European level changes affect us very, very directly. And this is very interesting because one way or another, the EU is a sustainable finance leader. And I would actually say that we're very lucky with that because, hey, we got to lead at least something. So in that sense, a lot of the thinking that has influenced how you hear the conversations, like in New York or in Shanghai, where I was recently, everybody's focused on understanding Europe and how they can actually adapt their systems to Europe, because nobody wants to have multiple different things. And I often hear a lot of skepticism saying, well, yeah, little Europe, but you know, what about China with all of its massive market and massive emissions? Well, guess what, guys? I worked on greening the Chinese banking system 10 years ago. They already have all the blueprints. Once they decide to move, it will take them maybe a year of implementation. Try doing something like that in Europe or even in one European country. We are not set up to govern or accept that kind of transition the same way. So for us, actually, this gradual, more reasoned part is probably the best way forward because we need to bring society and businesses along the way. So here, the whole idea of actually the Sustainable Finance Action Plan, and I think it's a very misunderstood policy file, was to reward those who are doing, actually trying to create sustainable businesses, the ones that are trying to create vehicles and tools for sustainable investment, and to reorient capital flows towards a lot more sustainable business models. Also, another element was to manage the risks that are coming from all this massive change in terms of climate, weather, etc., so to actually understand the risk better. And that's something that I don't know how many people realize, but it was actually demanded by the financial markets. They wanted standardized information so that you can understand risk better. In insurance industry, I can name, for example, Aviva has worked on it for decades now. So they already had a lot of models that looked at it. So again, it was nothing new. And finally, to foster transparency and long-termism. Because as nice as it is, it's very difficult to actually supervise or do anything if you don't know what's happening. So in a way, the more information we have, the better. However, there's one disclaimer. More data is not always better data. So we also need to ensure that the data quality is there. And finally, the EU Green Deal, of course, that's one of the main policies that then allows for finance to hopefully flow into the right parts of the system. We do have issues with hard to abate sectors, so that's going to be a big discussion still ongoing. How do we actually have competitive industries in Europe? And I think that a lot of the industry argues that, well, we can actually keep more expensive, better products of some sort in Europe, and some of the cheaper products will inevitably be done somewhere else. But that is the crux of the issue, because here we actually touch on social as well, because of course this is part of the just transition. And for that, we also eventually will need to look at how do we rejig the system and redistribution to be able to grow without major political backlash. And finally, on the EU policy note, what I think is super important to remember is that the EU taxonomy, and now you see explosion of taxonomies across the world. I didn't include it in the slide, but you have hundreds, different countries working on it. Kazakhstan has it, Chile has it. And the idea is very simple. Before this, we didn't have a definition of what is a green activity. And it wasn't really scientific, right? Everybody could say, oh, it's green because, you know, we are capturing carbon, or I'm baking cakes with green energy, so that's a green cake now. So the point was that there wasn't actually a very clear definition. And here what you got is a very clear set of criteria which you can navigate. So if you're in this sector doing this activity, you can actually use the taxonomy navigator and figure out, is it sustainable or is it not? And again, number one, it needs to have that significant contribution, and it cannot do significant harm. Sadly, like with all things, some of these things are still need to be improved for usability, and that's going to come over the next couple of years. So we're part of the EU Platform on Sustainable Finance, and I can tell you already that we are working on tackling do no significant harm. There's currently, I think, 3 or 4 technical support instruments across the EU, including, I think, also in Poland, on trying to figure out what the criteria is, how to create clear guidelines so that it's much more user-friendly. And again, we will release a taxonomy-aligned benchmark report in December 2023, so that's going to come in 2 weeks. So you can see actually it's a voluntary thing, and there will be a feedback period as well. But it should actually help clarify how to think about using the taxonomy in investing. And finally, there will be a compendium of best market practices of how to use the EU Sustainable Finance Framework in January. So this was a huge mammoth effort this last year, where several people from the platform were trying to find the best examples of how actually large and different types of companies are using the framework. So here you also see that there are some more advanced approaches also emerging in the fund industry. So here is just one example that we used. It's an anonymized fund. But you can see that actually they decided to have net zero, and then they have a very classic diversity and inclusion framework. And again, Pillar 1, Pillar 2, Pillar 3 shows the kind of way they think about the implementation stage. And it's very interesting because when you talk to market participants, everybody's asking for best practice. Do you have good examples? Can we get a best practice? But nobody actually wants to create the best practice. And in that sense, there's a really lost opportunity there. Because what I've seen often is that somebody who's the first mover and tries and creates a very good case study, that case study gets replicated. And then all of a sudden, you're actually a market maker. So rise of ETFs. I won't cover it in quite as much depth as my previous colleague did. But the interesting thing is that ETFs are definitely growing at an absolutely huge pace. And there's a good reason for it. It's actually for a lot of people, it's an easier instrument to understand. And it's also cheaper to run. I mean, my second in command is from BlackRock, and it was the same story. Why did you create so many ESG funds? Well, we could get massive fees, it was great. Why are ETFs interesting? Oh, well, they're much cheaper. They capture a different part of the market. It's interesting also to see that there's a huge rise in thematic ETFs. So again, picking either an issue, so it can be a socially responsible one, because now you have also social impact bonds, or you can have different types of environmental objectives. So that seems to be very popular. And interestingly enough, often the companies that perform best under the E or environmentally are technology companies. So there's a win-win there. And then also the active part is growing. So it's interesting to see that from completely passive, there is also an element of active now. So what happens when ETFs meet sustainable investing? So the interesting thing is that according to most academic studies up until this point, sustainable investing does not have a greenium, and that's just the reality. Green bonds haven't had a real greenium. There might be first evidence. I have some academic friends, professors have emailed me this summer that there might be first examples where there might be a small greenium. But there is a definite benefit in some areas. So for example, sustainable bonds, or usually green bonds, they trade better on secondary markets. So that seems to be quite an established fact also according to academic research. There is early evidence from Japan. So GPIF, or the Government Pension Investment Fund, is one of the most advanced funds on the globe in terms of long-termism. So recently they adopted a 100-year long-term view of the economy. I mean, makes complete sense, but it was still a huge novelty in this industry. So with their 100-year lens, next thing they did, they went and bought one of the most specialized gender lens investing boutique data providers. So with that, they're actually trying to also integrate all sorts of gender data because they've realized that, essentially women are the ones that hold a lot of the household spending power. They also really matter for terms of longevity, demographics, etc. So all of a sudden, that became a really big thing. And the interesting thing here, one of the things that I included is that actually they did have one ESG index-based passive fund that outperformed the Tokyo stock price index. And there's quite a significant performance there. Is this replicable? That's a very good question, because we would need to see what actually sits in that ESG index. So what are these companies? What did they report, et cetera, et cetera? It might be that all of these companies have fantastic fundamentals, which means great credit scores, et cetera, et cetera. Then what does affect performance? One interesting thing that links back to the previous presentation is that actually political volatility is not a very good thing. So here you see what happened after the Polish elections. So positive results, markets happy. Negative results, or results that cause a bit of a worry in the markets, that's not good for anyone. And that's one of the things that I guess is for our futures maybe a little bit worrying. The more polarized the societies become, the more volatility there might be. Some countries that have very long-run democratic systems, etc., and seem to be quite stable in terms of their financial and business markets, think Netherlands currently, they won't see the same fluctuations. So sadly, markets don't look at all countries the same way. So that stable business and investment environment is absolutely crucial. And also for people to invest money into green, usually they also do some political due diligence. So there are large investors who look at, is this country likely to have some negative developments in the green space? Will there be support for, let's say, green energy or transition, or will there not be, or is it under question mark? And I've seen some very bespoke models employed by big, large asset managers and investors to try and understand which of the CE and southern countries are a good opportunity, or which ones, we maybe put on the back burner. So very important thing is that most of the ETFs actually use ESG ratings. And I'm sure that most of you have read how different ESG ratings can be. We saw that Tesla, bad publicity when Elon Musk complained that Tesla had a awful ESG rating, and ExxonMobil had a great one. Well, guess that was all about governance. So governance does matter. We don't have yet sophisticated enough rating models, but I would say they will emerge in the next 5 years, because what's also happening here, there's competition upwards. So anyone who can show that they have a more in-depth, more granular, more accurate, or anyway more sophisticated ESG rating, there's definitely an upside to that, because, well, it's business. So you buy these ratings, you want to understand which company might be better. And then, even better, if you have 7 or 8 ratings providers, and then you actually look at where the ratings diverge the most. And that's where people have a second look, whether that's a great company to invest, or whether there's a risk that they haven't noticed. So actually, even the disparity between, the lack of correlation between ESG ratings, for some investors is a good thing, because they like it. They find new opportunity or a new risk in there. We do know that the issue with the ESG ratings has caused a lot of concern, and there will be also regulatory change there. So here, definitely slightly improved transparency of how are they created, what's the methodology, would be very welcome. So for example, not many people realize that you need to report almost on everything if you want the AI to pick up all the keywords. So there's a funny instance where there was a large company that doesn't do lobbying. That's completely forbidden. It's a state-owned company. They would never do lobbying, etc. But they didn't mention in their sustainability report that they don't do lobbying. And all of a sudden, once they started reviewing what they are reporting, after the inclusion of all the keywords, their rating jumped up 2 notches. So that's quite impressive. So again, understanding how the ratings work, what you need to report, and also reporting it in a way that it's easy to pick up by technology. And that's something that EFRAG is now working on, figuring out how do you report under ESRS so that it all can be collected correctly. The other interesting thing is that, of course, ESG data providers do have a conflict of interest. The arms between consulting and data providing weren't really, there was no insulation between the two types of business, and that's a real concern, because that should not be the case. Because what happens then is you might have the most sustainable business ever, but if you do not know or can't afford the very expensive consulting, then probably your sustainability report will not generate the same high level, high rating. So that does need to be fixed. So here you can see an example of an ESG index and its performance. This is a Refinitiv's one. So you can actually see that it's done very, very well. And you can see that the specific ESG scores that they use from their own database are CSR strategy, community emissions, human rights, environmental innovation, management, product responsibility, resource use, shareholders, and workforce. But again, no standardized reporting is used. So we will also see how the standardization and regulation in this space will also change the ratings. It's also very interesting to see that currently the ESG ETFs, one way or another, are skewed towards Western markets. And that's because we just don't publish these sustainability reports. They just, in most cases, don't exist, or they are of very poor quality. We are seeing some changes. So, for example, in Czech Republic, Chess Group has managed to be in the top 25% of global energy companies because of its reporting. It's won a lot of awards, and that's been a mammoth effort. But in general, we are still lacking good quality ESG reports, and we are lacking actually the know-how, how to create them. There was some preliminary research looking at how many ESG consultants there are in certain CE markets, and we don't have enough people even to work on this. So education and upskilling is a massively urgent need. So here you see, so is ESG actually changing something? Well, it's definitely creating a lot of hype in the market. So that's one thing that with the rise of ESG bond issuance, ESG funds, ESG ETFs, etc., we definitely are seeing an interest. Whether we are actually reducing carbon emissions on the ground, that's a different question. So also, very interesting specialization in this space is what I argued is the competition upwards. So it's actually the small actors get an opportunity as well before they maybe get bought up by bigger ones, as we discussed. So here you have, for example, Impact Cubed Smart ESG Global Sustainability Index. Couldn't come up with a longer name, I guess, but the interesting thing is that here it is actually targeting very specifically Scope 1, Scope 2, and currently still leaving out Scope 3. But if you look at the targets, those are quite big targets, so they're quite ambitious. And also, we are seeing a huge rise in number of exchanges with ESG guidelines, and this is one of the most welcome developments. Because one of the major issues that the SMEs and essentially companies face is wanting some sort of guidance, wanting information that comes from credible sources. So that is whether you have central banks or you have stock exchanges or even the government, every time a guideline on something appears, people like it because then you know that this is the approach, official approach, this is the signal that this matters. So it's very welcome that we have more and more stock exchanges also with guidelines. SMEs, of course, still remain an issue. They don't have to comply, they don't have to report. And currently there is work done on some sort of standardized, much more limited in scope reporting framework, also for SMEs, so they can report under ESRS. Because otherwise, what are the big companies doing under CSRD or the Corporate Social Reporting Directive? Well, they're using estimates, so it's not always very great. It's interesting to see that there are SMEs that actually have started reporting, and then when we actually did some interviews as to why have you started, he was, oh, our investor forced us. So actually that's the power of the investors giving money. The same thing that we're hearing now through banks is, oh, we will send them these standardized surveys. So that's where the pressure comes from. The question is whether there's going to be an upside. So am I going to get a faster loan from my bank or a loan on preferential terms if I have an ESG report? Or will an investor give me more money? So these are the questions that we face day in, day out. And that's something that also we suspect will start changing in the next 5 years, because currently we are just taking the baby steps. So the Polish context. It's actually very interesting that the Polish market is very big and very, very important in the EU. And it is quite untapped because there's a lot of opportunity in it. And exactly in the green agenda, I think there's much more opportunity to attract capital than there is in the kind of business as usual agenda. Because here, the Western capital markets, so the actual asset owners that are under pressure of generation X, Y, Z, you name it, and also from PR perspective, etc., whose boards are much more educated on ESG and are asking, well, what are we going to do? Here, the impact statement and the story from this region is 10 times more positive. Because what you can do in Netherlands with the same amount of money is much less what you can do here. So in that sense, there should be a perfect alignment. But again, we have major issues with the intermediary and the translation and the money flows. So it's again a capital markets underdevelopment issue, and also an issue of trying to create the right type of investment opportunities. And here the government and the policy also come in. It's important to have stable environment, good messaging for the money to be unblocked. At the same time, Poland actually has a lot of savings. So people have been getting richer, they have money, but the traditional way of investing is usually real estate, so quite illiquid investments, and not a very high sophistication of knowing how to use these different types of investment opportunities, whether it's stocks, whether it's actually ETFs, etc. Interestingly enough, when we did the research, you can actually see only 4.3% of Polish assets are held in investment funds and 3.3% in publicly traded shares. So it's tiny. On average in the EU, it's approximately 10%. And then if you look at the countries where the households invest the most, Cyprus and Luxembourg are the top two, according to Eurostat, which makes sense. Luxembourg is a tiny country with highly sophisticated professionals that usually work in finance. And then you also actually have quite high up Estonia. So there you go. Again, a small country, but much more digitalized with a lot of easier ways of how to invest. And again, a lot more conversations driven by the central bank, etc., on financial literacy. So people feel a lot more comfortable with investment. Financial literacy in Poland actually is not bad. So I think this should be celebrated. You look at some other countries and it's really shocking. So here it's not bad. So this is something to build on. We've seen some very cool initiatives. There's Erste Bank, but their Slovak branch has actually created a VR set that folds up like a little, well, it literally fits into your pocket. You unfold it, you put it on, and then you open an app on your phone, and it's a game that actually teaches you everything about the financial system. And you can even play with fake money and invest. And it's won a lot of awards. And apparently by now there's at least 20,000 young people who have gone through it. And at the end, when they're asked, how comfortable will you be with investing? Do you understand compound interest rates? The answers are really encouraging. So these are the different ways how you can also gamify it. The Latvian Central Bank has a special, again, game for children that they do in primary schools, again, on investing, of how the money system works, etc. And again, very proactive engagement and partnerships with schools. So here, there's definitely a lot that can be done better. And it will be interesting to see, right, who's going to take leadership. Because with all of these things, these are human-run systems, and that's one of the most important things, that this is not some abstract thing. Somebody can actually take the lead here. And in this case, it was somebody at Erste Group who just had this idea and went to town with it, won an internal competition to get the money to start it. In the central bank, again, it was somebody who just said, well, why don't we try with a basic pilot? And if it works, then we can scale it up. So again, here it's the proactive leadership that I'm afraid across the CE region often is a bit lacking. And I don't know whether that is the risk aversion or whether it is something else, but I think proactive leadership here is really needed, both on political, financial level, private business level. We also have a lot of issues, of course, with implementation. So here, it's essentially, these are the kind of things that matter for the future of profitability. Because if you look at where most of the products are sold to, they're sold to large companies in the West, sometimes in the East, but the issues are that the same reliance on raw materials, reliance on water, reliance on energy intensity are the same everywhere. So this is something to really keep an eye on. The interesting thing is that we finally got a lot more interest in the social indicators, first after COVID, was huge interest, and now after Ukraine. And I think this is something that also needs to be revisited, because how we understand the social aspect is very, very important. Here, there's a lot more products and things that you can create. We have seen now 2 V4 governments looking in social impact bonds or social bonds to try and figure out how to actually make sustainability not just about the E, but about the S that then has a positive effect on the E as a secondary purpose. So that's something that I think is overlooked. It's a big opportunity right there because politically it's a positive thing. In general, it's a nice and positive message, but also the actual direct impact on GDP and the purchasing power is really good. Then, so who are the people with the most influence in the system? And here I would say that the large intermediaries can play a big role. We do see that EIF requests matter a lot. You have EBRD that is trying to also help the market develop. You have EIB acting very, very proactively trying to develop this market. How this is going to fare in the future, we will see. But the point is that here it's the homework actually domestically to try and pretty much catch up with the agenda, because otherwise it will always feel a bit more obscure and too advanced. It's also interesting to see that one of the most active parts of the system, of course, is insurance. That's for a natural reason, because all of a sudden insurance premiums might have to go up. Do we really want to insure certain businesses? And of course, banks, because the stranded asset debate is a real concern amongst a lot of banks. And one particular portfolio for investors and banks that is gaining a lot of attention and worries is, of course, real estate. So real estate is one of those complicated assets that is a long-term asset, but if you invest a lot in its decarbonization, then you need to make sure that the value goes up accordingly, et cetera, et cetera. So that's one of the most complicated things that currently I think there's a huge amount of work going on, and we will also be publishing a special report on that. And here's the basic breakdown of what the CE issue matrix is. So what is the kind of barrier, or what are the main issues why we don't have more ETFs or more ESG? It's actually, we do have a leadership issue. It sounds a bit silly, but even when you see very strong developments inside some companies or some financial institutions, it often hits a certain level of board unwillingness or lack of support. And we hear that time and again when people like, we did really good work, but at the board level, nobody actually understood what we were talking about or why this matters. So I think actually investing a lot more in the board level education will be absolutely key. We had a very interesting conversation. We had the opportunity to talk to President Obama in June, and he said that that was his main concern, was that people at the levels of supervision and power, so board level or people really in power in government, don't understand climate change, and they don't understand digitalization and AI. And that's a huge risk, because you genuinely have no idea how this can change the business model and even life as it is. So what the fundamentals of the economy might be 10 years down, they're not very well equipped to think through that sequence. It's also very bad when boards have too long a tenure. There's nothing wrong with long tenure, but if you have 20 board members where the minimum tenure time is 15 years, then you've got a bit of a blind spot in terms of like, what might be happening. We used to work on board groupthink issues, and they were very pertinent in boards that had sat together for the longest possible time. So certain risks, oh yes, I didn't speak up because, we all know each other. It's like, fine, I'm sure it's going to be fine. No, that's a risk. You should speak up. And then it's also very interesting to see this rise of wokeness or anti-wokeness. And that's a real big issue because, again, it's linked to polarization. We should be able to talk about anything and discuss almost anything, and especially when it comes to the future of a company or a bank. And there is definitely a lack of special attention to G and ESG. It's mainly about, how do we comply? How do we get ratings up? Rather than really owning the topic and figuring out, how do we govern better to then serve better purpose, have better shareholder value, etc. There's issues with know-how. I already mentioned that. There's really very few good quality education opportunities, or they're very expensive. Lack of government action. We definitely do need a lot more ownership of this agenda also from the state level, because the markets can develop only to a certain extent. There are certain policies that might be blocking the development of certain types of capital structures. And then finally, we do have actually a very fragmented system. I never thought it was quite as bad, because I predominantly worked in the Nordics at the start of my career, so I got used to a completely different matrix of how government, finance, and business work together. They actually often set up joint things, they discuss matters, and it's done much more transparently. And here we don't seem to have it quite the same way. There are some recent initiatives where that's being tackled, but I would argue that there needs to be definitely a much more improved conversation there with multi-stakeholder approach, because that is a very big blockage in terms of improving policy. And sometimes it's small tweaks, but they can make a really big difference. So for example, in Sweden, it was the industry that initiated Fossil-Free Sweden. That was done together with the government, and it was a platform of multi-stakeholder interviews, figuring out the financial models, then arguing about them, and then figuring out essentially how do you make everybody equally happy or equally unhappy, and how do you move forward? And that was a very smart way of doing it because, yes, it didn't take 1 year, it took 5, but everybody was on board. And yeah, ESG know-how, that will be one of those crucial skills that pretty much we needed to learn how to use an iPhone. Well, we will need to also figure out how do we deal with digitalization, electrification, and climate-related ESG things. And again, there are certain things that are super positive here. So it's not all just negative, like, everybody's super depressed after the conference. No, there's actually a huge amount of opportunity. So number one, we actually can leapfrog. We've seen that in a few cases. So for example, this private equity fund I mentioned, they leapfrogged. They didn't spend thousands upon thousands of euros trying to figure out how to set up an ESG carry. They borrowed it from someone else, just adapted it to themselves and made something that actually worked for them. Again, ESG guidelines and all of these requirements, because the market still isn't developed in this aspect, there's a lot of educational activity, just like this Knowledge Forum and others, where you can really drive the understanding and actually make sure that people are already future-proofing their ESG strategy. So there's no point in doing the bare minimum if you have to redo it every year. So that's very important to remember, that it's actually pays off to be a little bit more ambitious and already know where you're trying to go, because then you won't have to change it every year. Communication. I think that we're not particularly good storytellers sometimes in this region. Somehow we lose the message that, ESG is actually about cleaner air, cleaner water, and better work conditions, because that's actually at the core of it. And then the question is, how do you link it to, essentially, if I'm a business trying to do the right thing, there's a great internal marketing value to it, and external marketing value. And on political level, it's also actually quite positive. You can say, listen, we care about people and their well-being, and we also care about natural environment. And people do love their food. That's a reality. So for example, we as Latvians, we love mushroom picking. So once the mushrooms started disappearing because of deforestation, all of a sudden there was a perfect storytelling moment saying, well, it's actually linked to one particular policy that we need to change because it's pretty much losing us our mushroom picking spots. So what you use in each country can be different, but it's actually about making it easier to relate to rather than having these abstract things. And I think that that's one of the storytelling things that we need to also tell people. And maybe that's also about investing, trying to convince people that this is not just for certain types of people or that it's super risky. It's actually telling a solid, simple story of why it actually makes sense and why it's good for you. And then finally, we all like things that are easy to use. So here, the digitalization space is a fantastic opportunity where you can improve the user friendliness. Because the more user-friendly the product is, the more people might actually use it. And that same goes with investing. My husband works in banking. He has multiple apps, and he's like, oh yeah, today I'm not doing this, I'm moving the money here. So the point is, making it very easy is also an important winning point. So, and then the final question on which I'm gonna end. So why on earth are we even doing all of this, right? Well, the reality is that the impact of climate change, one way or another, can be pretty unpredictable and dark. And my main concern is actually the food costs that could, if there are issues with how we can maintain our food supply chains, if food becomes very, very expensive, people are going to be very unhappy and there's going to be further polarization. If we will have huge heat waves and forest fires on repeat every year, it's also horrible because people will die. And in that sense, I think that it's worth to remember that this is not just, we're not doing it for something very abstract. It's actually very real, and we already are experiencing and living it. Maybe in some areas of the world less than others, but in any case, it's not good for systemic sustainability, etc. We still want to have a nice world. We want to go on holiday to Greece without having to take out extra insurance in case the island burns down. So I think in general why we're doing it is because, well, there's certain issues that we need to fix, and it's inequality and climate change. And some of these financial instruments can actually help us move the needle. And I do think that Bill Gates had a good point when he said that we always overestimate the change that will happen in the next 2 years because, oh my God, ChatGPT, all of a sudden everything's going to get automated. Well, it might not be that simple. It might be that actually the biggest change that we really don't realize will happen in 10 years. And I think that's happened with a lot of these different instruments. If you asked somebody 10 years ago if ESG was going to be regulated, there would be an EU taxonomy that's going to be mandatory, people would laugh. 10 years ago, people didn't even understand what a climate stress test was in the banking industry, or very, very few people did. Now it seems like a standard practice. So we just don't know which parts of this will become something that really, really either kills or enables your business. Thank you.
Thank you. Thank you for your presentation. And now the Q&A part. There are some questions from the audience. Everything was clear? Okay. So that was all presentations for today. Thank you, our speakers and guests who are here with us in the room and those who are watching us online. This was the first edition of the Knowledge Forum organized by the Warsaw Stock Exchange in cooperation with World Federation of Exchanges and their International Sustainable Finance Center. Big applause. In advance, we invite you to the next meeting, and now it's time for lunch break and networking. Thank you very much.